Good morning, dear friends, dear colleagues. We are here for the 8th Education and Financial Reporting Communities of Practice joint meeting of PULSAR, a program which doesn't need too lengthy introduction, as we know each other quite well in the program itself. For the opening remarks, I am very pleased to pass the floor to Adrian Fossard, who is practice manager at the Governance Global Practice Europe and Central Asia East, and also chair of PULSAR Steering Committee. Adrian, thank you for joining us, traveling from DC, and for opening. Thanks.
Is this turned on? Good morning, everybody. Pleasure to see you here at this event. On behalf of the WorldBank and the PULSAR team, it's my pleasure to welcome you to our 8th PULSAR in-person workshop, joint meeting of the FinCoP and the Education COP. As Armand said, this is the first time I join you, so I'm here actually to learn as much as to talk. I'm particularly interested in the themes that we're going to be discussing today. I've heard a lot about PULSAR. The activities the program has been running for quite some years now. And it's important to see that the significant impact the program has had. This morning I actually looked through the survey that many of you filled in. I think it must have been in Batumi.
Yeah.
And I was quite impressed by the fact that there was such interest in the knowledge products, and that so many of the products had actually been used by various countries, both for the training work and the work in terms of developing legislation and developing accounting methodologies. So it is obviously an event that has, and a program that has quite a significant impact. I think you do discuss very important and useful topics related to public sector accounting, and the introduction of accrual accounting is particularly probably one of the themes that's particularly important for the bank and for many of your countries, and probably one of the biggest challenges that your profession has had over the last, well, many years. And I know that many of the countries are struggling how best to achieve the full implementation of accrual accounting. PULSAR has also been a very successful program in terms of developing new diagnostics. You understand that you're implementing a new pulse diagnostic, and it's now being piloted in Ukraine and Armenia. The last time you were here in Vienna, there was a ministerial conference with senior officials. I understand that the meeting took place in the Hofburg Palace, which is obviously quite a dramatic environment for undertaking this kind of event. So it's very good to see you back and reconnect and have the opportunity to discuss some of the emerging issues. There are 3 issues on the agenda which I think are particularly interesting for the bank and the work that we do. On consolidation of financial accounts. I was actually just discussing with our colleague from Tajikistan this morning some of the challenges that they have in implementing this across so many government entities, given the disparate capacities of accounting bodies across government, the challenges of accessing information on a timely basis. So another issue around financial management information systems. I mean, this has been a core business for the bank in public financial management for the last, 20-odd years. When you look back, I think the bank has financed about 120 financial management information systems across the world. And I can't imagine a World Bank financial management project which doesn't actually have an information technology component. So this is a critical part of our agenda. And also to talk about sustainability reporting in the public sector. This is an emerging agenda. Personally, I think this is probably one of the biggest challenges for the world and for your profession as well after accrual accounting. Money makes the world go round. And if you can't put a price on it, nobody will listen. And I think that counts for the environment as well. And given the environmental crisis that we all face and the significant impacts that's going to have on all of our countries, I think that we really need to make an effort to think as a profession how we can integrate sustainability into our work and how we can put a price on what matters and make sure that those decision makers have access to that information and able them to factor that into decision making. So for the bank, certainly this is a core part of our agenda. They've recently changed our mandate. It used to be ending poverty and shared prosperity. Now our mandate is ending poverty on a livable planet. I think that's a laudable aim, and I think that's something that we should all be striving towards. There's clearly a huge role for the public sector to play on sustainability. I think dealing with it through the accounting side is an important element. Look forward to hearing developments in your countries during these sessions. I think it's important for you to hear you discuss because it's an opportunity for us to learn as much. I'm sure my colleagues who are specialists on the accounting side learn a lot from the discussions from you that are actually working on the ground, working in terms of trying to apply accounting principles in your government entities. And I think you learn more from each other as you chat than you do from the sessions. So I hope there's plenty of time for people to talk. I know any event that Arman is organizing, there is always a large element of socializing as well. And there will definitely be large cultural event, probably involving a meal? Yes?
Yes.
Oh, definitely. Okay. So, well, I'm sure you'll have plenty of opportunity to meet and fraternize and discuss areas of common interest. So the other element I think is important is that PULSAR is at a sort of crossroads at the moment where we have to start thinking about what we do next. And there's a steering committee meeting on Thursday afternoon to decide what's the next phase of the program. So it's going to be interesting to hear from you about what you think is important. And I'd really like to hear what you think the priorities are as we go forward. What do we need to do? Certainly, it was very interesting to read the survey results, but it's also I'd like to try and chat with a lot of you during the next couple of days to hear from you in person what you think would be important for us to do to sort of embed in a new program. So thank you very much, everybody, for taking the time to come. I'd like to extend a special welcome to our colleagues from Tajikistan, who I understand this is the first time they joined the event. Yes. So maybe you stand up since there are new participants. So to the colleagues from Tajikistan, never been before. And I'd like to extend a special thanks as well to our colleagues from the Austrian Ministry of Finance and Swiss SECO, who have financed the PULSAR program and enable us to host these wonderful events and finance all the knowledge activities that the program delivers. And so thank you very much. And I really look forward to the discussion over the next couple of days. Thank you.
Thank you very much, Adrian. Thank you for joining us, and thank you for your strong support of PULSAR program. As probably accounting is very hard to be seen and supported by many country governments and within the bank, but you provide a very strong support to the program, and this is key for our team as well. Thanks for that. And yes, today, as you said, we are going to concentrate on the topic of consolidation. How do we consolidate using different levels and considering the decentralized organizations, even subnational governments and SOEs, and we have top experts, global experts in this room, and this is a unique opportunity to interact and get access to their knowledge. So here, as always with PULSAR, we have this unique opportunity to get the best and the deepest knowledge, up-to-date knowledge globally, so which inform our reforms and which makes us, when we are back to our countries, comfortable. Whatever reform we take, whatever decision we are taking back home and advising our ministers, governments is or are the most accurate and relevant ones. Of course, here we will also talk about the instruments, as always, because we are practitioners. We don't only talk about the good practices, standards, but also how to implement in practice, including IFMIS, Integrated Financial Management System, and we have Huram with us and bringing lots of experience globally on IFMIS implementation, and that is connecting to our reality. And as Adrian said, sustainability reporting is key. And yes, as we started exploring in Batumi, sustainability reporting is very important. Even the WorldBank, as Adrian indicated, which changed its vision. Now we have a clear words of a livable planet. And the question is what we are going to do with that. In reality, it will end up that this team in this room is going to be most probably in charge of sustainability reporting as well. And if you recall in Batumi, we discussed a few reasons why. One is that 50% estimate of sustainability, sustainable resources are at the government possession or impact. 40% of capital markets are again at the governments. So, and investors nowadays, they are paying very much attention to sustainability reporting and sustainability aspects. Of course, we are going to elaborate that in detail. And as for this opening session, I'm representing Dmitry and Garik because Dmitry is running FinCoP. I would like just to use this opportunity to thank Dmitry for a lot of his work for organizing this event, and to Garik, who is taking over from Dmitry for the FinCoP, Financial Reporting Community of Practice, tuteleship and co-tuteleship. Between Dmitry and Garik. So I would like to thank them because they couldn't join. Garik had actually Corona unexpectedly, not linked to our event, and Dmitry couldn't travel this time, and he will join us virtually. And I would like also to note, as Adrian said, it's very important for us on a first day to shape our future priorities and not for our next event, but please think about your country priorities for the next 3 to 5 years, where you would like your countries to work on within the next 5 years. And on first day, we will we'll get your feedback on a more strategic basis. What are your priorities? Because this we are going to consolidate and go back to the donors on first day at the steering committee and start to engage with them for PULSAR 2 funding. And this will be our future shaping, and your topics of priorities are very important for us. So we reflect on the right ones. And again, thank you for all of you and for, of course, our donors for support and our distinguished experts globally recognized and just simply very good friends for joining this event in Vienna. Thank you very much, and I'm passing the floor to Jose, who is the EduCop task team leader. Please.
Good morning again, colleagues. On behalf of the Public Sector Accounting Education Community of Practice, EduCop, it is also my pleasure to welcome you again to this joint EduCop FinCoP workshop. We will have 3 full days of interesting discussions, and we hope you will learn both from the distinguished panelists, but also from your colleagues as well, because that's the power of a community of practice, to chat within a group with similar challenges and learn from each other. So on the EduCop side, we will have the opportunity of present the results of our latest knowledge product on PSA, Public Sector Accounting Education Models, that is soon to be published, which outlined the PSA education in 6 countries and features different models of PSA education at university level, technician qualifications on PSA, and certifications. This was presented as a draft in our workshop in Batumi. Now the product is completed, and we want to talk on what were the main findings. We will have also a second session where we will have the opportunity, of course, of discussing the new challenges for public sector accounting education, including, of course, sustainability, reporting, digitalization, and other upcoming development areas. Also, as discussed during our workshop in Batumi, we designed the agenda taking into account the priority topics and the greater interest of our COP membership, and we will continue this practice. As you know, on Thursday, we will be able to discuss on the future of PULSAR. Thanks again for taking the time to join us in this event. And without further ado, I would like to pass the floor back to our man to lead us into the first session of the workshop. Thank you very much.
Thank you, Jose. Now I will invite speakers. Yeah.
Good.
So I would like to invite, yes, Ian Carruthers, IPSAS board chair, and Sache Declare. Yep, please. I would like just using this opportunity to congratulate Ian for re-election as a IPSAS board chair. Until 2025, we will have Ian chairing the IPSAS board. And as in our case, Ian is not only the chair, but also has significant country experience, UK Treasury, working in UK Treasury and also on PFM and accounting on the coordination of the accounting reform side. Now we have also with us John Werner. I don't know whether John can hear me. John is the head of the EPSAS, European Public Sector Accounting Standards expert group, but this is a group which is developing European, as you are aware, European public sector accounting standards using IPSAS as a reference. And also last week we had with Ian, we were there with Thomas in Luxembourg on their meeting, on EPSAS expert group meeting, and they are also discussing similar topics of consolidation reporting, and quite sustainability was also touched already. So the topics which are also quite similar to the PULSAR priorities. And Sache de Klerk, of course, you know Sache very well, from IMF Fiscal Affairs Department, bringing 12 years of experience in statistics, and also from the country experience of South Africa, Republic of South Africa, in being in charge of GFS reporting. So, Ian, would you like to go first? Just to check whether John is connected. Anara, can you please confirm he connected? Okay, go on. Thanks.
Can I just check everyone can hear me okay? That's good. Great. Well, thank you very much, Armin, for the introduction. It is wonderful to be back here again in Vienna. I was trying to work out whether it was 4 or 5 years since I was at the equivalent event here. And I think genuinely this week, actually, it probably is all roads lead to Vienna, because not only is PULSAR here this week, but also the International Federation of Accountants is hosting its annual council meeting, which brings together representatives from I think it's 170 professional accountancy bodies from around the world. So very much Vienna is the place to be this week. In terms of this presentation, as Armin mentioned, although I'm standing here as chair of the International Public Sector Accounting Standards Board, in the past, I was sitting where you are sitting now, because I led the implementation of whole of government accounts for the UK government, starting with nothing more than a desk and a PC and a blueprint for how to do this. So, you know, I very much understand the challenges that you're facing. So in terms of what I was going to talk about in this session, I'll give you a brief rundown on and a reminder of the relevant IPSAS in this area. You probably know the ins and outs of these standards in greater depth than I do, because you're working with them day on day. But I wanted to focus then, and this is where it'll move into the discussion with John and Sahe, really on the use of the information, not only for accounts preparation, but for government finance statistics. And I think that's tremendously important, and it's something that personally I really believe in very passionately from whole of government accounts days, where the whole point of developing whole of government accounts for the whole of the UK public sector was that that information would provide better information for fiscal management. And I think that link into public financial management is really important, and that's really where I'll end up in terms of the end of the session. So in terms of the relevant IPSAS literature, there is a group of 5 standards which really are at the core of how IPSAS looks at consolidation and control. And I almost feel that actually my predecessor, Andreas Bergman, who is sitting at the back of the room, should be standing here, given that these 5 standards were all developed and approved under Andreas's chairmanship. And I do remember the day, I think it was in Toronto actually, where we approved all 5 together, which is probably a record. So there are the 5 standards, but also relevant, I think, is our standard IPSAS 22, which is not a mandatory standard, but it does actually give you an approach to disclosure of information about the general government sector. So it's that bridge into the statistical world. And also potentially, although I won't talk about it, public sector combinations, IPSAS 40, again, I think is very important in terms of how you approach public sector combinations. And certainly we know that really the challenge with the public sector in most jurisdictions is that it is constantly changing. So you have to think about bodies moving, being merged, demerged, moving between levels of government and so on. So there's a lot to actually think about. And I would say that one of the fundamentals in this is when you're making these decisions about should I consolidate, where should this body sit, the more that the accountants and the statisticians can talk together and achieve agreement, that is really fundamental. You can't do this as accountants on your own, nor can the statisticians do it on their own. You need to work together. So just a reminder then in terms of the principles, and this is an area where the IPSAS are actually very closely aligned with the private sector literature. And so the concepts which govern control are around the power to direct activities, and then also the exposure to variable returns. Now, clearly that is crucial in the private sector. I think it's more subtle in the public sector in terms of what that actually means. But nevertheless, the same principles do apply. And that's really one of the fundamental principles behind IPSAS, that if the same principles can be brought over and can apply in the public sector, and they work for the public sector in the same way as the private sector, then we should actually use the same principles. We might provide different terminology, we might provide different examples, but fundamentally the same principles, if they're applicable, should be brought over. So then other, if you like, shades in this area in terms of whether there is actually, if you're looking at other bodies' involvement, is control joint, or actually do you not have control, in which case maybe you have significant influence. So there are those shades of control. And again, I think in the public sector, one of the challenges is that in the private sector, very much this is driven by an analysis of what are the relative, the different categories of share capital actually provide in terms of control. Very often in the public sector, you have to look at some more subtle things in terms of the degree to which ministers, for example, control the activities of organisations. But fundamentally, the same principles apply. And those differences in terms of the degree of control then have consequences in terms of the accounting, where you definitely control a body, consolidation is appropriate. But then you've got different types of joint control, depending on whether it's a corporate vehicle or whether it's actually the assets and liabilities for an organisation that are controlled. And that drives the accounting, as does where you have significant influence. So that's where you're looking rather not at consolidation, but at equity accounting. And it may well be that that's the nature of the relationship is different, for example, if you've got financial instruments and so on. So there's quite a lot to think about, and it can be quite challenging. Certainly, I've looked at this in a lot of different situations. So it's important not to leap to conclusions, but really to think about what's actually happening in practice. And then I'll just show you a diagram which is actually in IPSAS 35, but what it does is it guides you through the thought process in terms of how do I approach thinking about this. And so it really depends on do you have control? And then if the answer to that is yes, then you're in IPSAS 35 and you're looking at control. If you don't have control, then the question is, do I have joint control? And if the answer to that is yes, then what type of joint arrangements do I have? And if I don't, then that brings you down into IPSAS 36. So you can see there's quite a logical process to go through in terms of how you use the standards. And I would say, I think this. Personally, I've always found flowcharts, decision trees a very helpful way to work through some difficult practical issues. And I would say use this decision tree to help you and guide you through thinking around all of these various different situations that you're going to find. And then you've got also other standards, IPSAS 38, which is where all the disclosure requirements are, and also IPSAS 34 on if you're preparing individual statements. So this is a group of standards that do hang together, but this decision tree is very much at the core of that thought process, and it's very deliberately a process to go through and think, where do I actually end up? Which standard do I end up in? So this is really where I want to bridge over between the accounting and the statistical reporting. And I think in the way that you think about this and approach this, it very much depends on the sort of colloquial expression, is it glass half full or glass half empty? Because personally, I'm always a glass half full guy, and actually I always think that it's possible to achieve agreement between the financial reporting and the statistical communities in most circumstances, providing you actually have a discussion early before people actually dig in on this. And I say that through bitter experience in that we had a situation with our rail network in the UK where I was sitting there and the statisticians backed by Eurostat were saying, no, this is not controlled. And because the audit office had come in rather early, and maybe not on the latest version of the agreement, and has said, no, this is definitely controlled. And I'm sitting in the Ministry of Finance going with the Cabinet Secretary emailing me saying, where do we go on this, Ian? So it was down to me to try and find a way through that. So it is tricky, but I think when you actually look at the subtleties of this, I think it is possible to achieve agreement. And the fundamentals come down to the fact that GFS would look at the ability to determine general corporate policy, whereas the accountants would look at control. Now, I would say in most cases, actually, probably the factors that you use to make those decisions, actually, you can achieve a commonality of view. What that does, though, in terms of the different approaches to how do I think about this and where do I put these bodies, that's where some of the challenges come in. And what this diagram is trying to show you is very much the sectoral view that statistics would take. And obviously, general government is crucially important in terms of control. Certainly in Europe, general government is the focus very much in terms of the fiscal frameworks. So big divide between general government and public corporations. From a financial reporting point of view, that's not so important, because if there's control, then you would consolidate. And that's really what the circle is showing you. That doesn't mean that you can't disclose, and I'll come on to that in a minute. But it is very important that that control would perhaps give you a different grouping depending on the different levels. And that's really where there's difference between classification into sectors and also the market, non-market distinction. And Sahe is far more expert in that than I am, although we've discussed these matters on many occasions. And then there is the issue about, foreign residence units, but my experience on that is that tends to be relatively minimal compared to the jurisdiction. Just a reminder of the sectors, because it is important, that worldview in terms of statistics. And really, it's the centre block that we're talking about, general government, where all institutions are in the public sector. Obviously, households and non-profit institutions serving households, those are in the private sector. Financial and non-financial corporations can be public, they can be private. And again, this point about what do you control becomes important there. Now, I mentioned earlier on the IPSAS 22, which is not a mandatory standard. It's something, it's an approach where you want to disclose that information about the general government sector. So it's in addition to the other IPSAS, for example, you still need to do segment reporting there. But very importantly, in thinking about it, if you're going to want to do this, you need to think about how you're going to approach eliminations, because you would not eliminate between general government and public corporations, financial, non-financial. And you need to think about how you're going to treat your investments as well. What the standard does, it's a disclosure standard, so it does give you some minimum disclosures, very much with reference to your financial statements. So the requirement is to reconcile back against those, then with the option to reconcile against your statistical information. So if you look at this as an example in practice, and apologies that this is very small print, but I want to show you that this is possible. This is actually an extract from the UK's whole of government accounts. And what it does is it reconciles between the statistical view of the world, both for the balance sheet and for the statement of financial performance, and the accounting view. And I think this is something that you'll hear more about during this event, in terms of the difference between a net debt measure and a net worth measure. And what the net worth measure brings in is things like the liabilities of schemes, pension schemes for current and former employees, but it also brings in a view in terms of property, plant and equipment and other forms of assets. So it's a much more rounded view. So what this table does is it shows you the key areas where you've got a difference between net debt and net worth. And some are differences of items not included, like I've illustrated. In some cases, things are measured differently because of the different requirements of system of national accounts, government finance statistics, and so on. But it's useful information, and it does give you that view through, and I think that's very important. So, not saying that there aren't challenges in this, because there are. I think one of the challenges actually is it's a relatively small group of people who really know both sides. But I think it's speaking personally, I think as an accountant, you can pick up enough that you can actually make some educated choices. I think that's where, for example, I would say, I think when you look at charts of accounts, this is where one of the PULSAR publications, I think, is excellent in terms of actually showing you how you can produce both GFS compliant information, but also IPSAS compliance information. And I think that was a tremendously important addition to the literature. And then there are some issues about how do you treat changes in accounting policy and so on. But I think going back to the approach you take to this, personally, I'm always glass half full rather than glass half empty. So I think the benefits and what you can achieve far outweigh the challenges of this. Now, just to sort of wrap up, I think really this is where, when I approached this was actually something quite strange and not many people actually did it. I would say you're part of the movement to accrual reporting around the world. And I think the benefit that you have is, from those of us that went before, and I would strongly urge you to think about the use of your information from an accounting perspective for statistics. And as I mentioned, this is very much a global movement now. You can see that in the International Public Sector Financial Accountability Index, which IFAC and CFRR developed and provided the first update based on the 2020 position. It shows you that very strong trend from cash to accrual, which is going on around the world, whether we're talking about PULSAR countries, Latin America in particular, but also Africa and Asia, as well as Europe. This is happening around the world, and the trends are actually quite similar. Very much up to 50% we were projecting in 2021 when we did the report, in 2025, and then up into the 70% by the end of the decade. So this is happening rapidly, and as I say, it's happening around the world. We will be updating this index, so we would appreciate your help in terms of giving us your up-to-date position. Very important that actually we get the maximum amount of coverage. But if you want to look at the original report, it's on the IFAC website, and that also gives you a breakdown by countries, which isn't in the report itself. And what is also happening is very much that whereas some of the earlier countries were not using IPSAS, now that's the case that people actually are using IPSAS, so you get that comparability between jurisdictions. And what is it about? Well, it's really about trying to get a view of what is actually happening and what are you accountable for in terms of delivery. And it's very common that you have different frameworks, different ways of looking at that, depending on whether it's accounting, statistics, or the budget. And really the message is the more that you use the same information, the more that there is a single version of the truth. It's not, well, oh, this is a technical difference and da-da-da-da. It's actually you're focusing on the right issues in terms of asset management, in terms of liabilities management, and people can see the issues and actually take the decisions that are needed in order to address those issues. And frankly, wherever you don't use the same sets of information, there is a challenge in terms of the quality of that information. So I would really encourage you to think about this in a joined up way. It's not just an accounting exercise, it's about better information for fiscal and budgetary management. And with that, I will conclude. Thank you very much.
Many thanks, Ian, for bringing it the consolidation for conceptual and macro fiscal perspective. And I mean, two numbers: 3.3 trillion net liabilities versus 400 billion. I mean, UK case that makes a clear case for IPSAS. And another one, in 6 years' time, we will have 73% of countries following accrual IPSAS. That's also a major fact for all of us. And now I would like to just check, John, whether John can hear me.
Yes, hello.
Yeah.
Good morning, everybody. John
Good
here.
morning.
Can you hear me?
Yes, we can hear you very well. Thank you, John, for joining us. The floor is yours, please.
Thank you very much. I think my slides will be shared locally, but just to say good morning, everybody, and it's a pleasure to be invited to speak here. I'm sorry I can't be with you in the room, but hopefully I can present a few slides and update you on more or less the situation in Europe, maybe some lessons. So I'm working in Eurostat, and I have sort of two hats in a way. I work in the statistical area in national accounts and have worked for many years in government finance statistics in the past. But also I'm responsible for Eurostat's work on public accounting, including the EPSAS project. I'm afraid I can't see if my slides are being shared.
Yes,
are they
are shared? Yes, they are shared, John. You can go ahead. Thanks.
Very good. So next slide, please. So this should be the overview slide.
Yes.
And what we'll do today is have a look at a reminder of European fiscal governance and EPSAS project. Some of you will have been in the last event, so I'll be brief on this. Then talk a bit about the discussions in the EPSAS project on consolidation. Talk a bit about consolidation in European fiscal statistics, and also towards the end, linking a little bit the consolidation that we see in public accounts and public accounting with the consolidation in fiscal statistics and some of the sort of difficulties and lessons that we've learned over time. Next slide, please. So, as many of you will know, in the European sphere, the fiscal governance is very much based on government finance statistics. The so-called excessive deficit procedure sets limits for government deficits and debts. Underneath that, there is a lot of analytical work using government finance statistics, and I think some of you are probably aware that there are ongoing discussions about this governance, economic governance in Europe. And I believe more and more emphasis on expenditure benchmarks, but at least we have the government deficit and debt, we have the fiscal statistics as the basis for the discussions. The EPSAS project, European Public Sector Accounting Standards, is focusing on working towards harmonised accruals-based accounting standards across levels of government and between countries in Europe. So the idea here is that it's obviously accruals-based, but what we are looking for is harmonisation of the accounting standards, which will thereby improve comparability, not just between different governments, but also within countries where we do see, and this is highly relevant for consolidation, we do see different accounting standards at different levels of government. And the other area in Europe, which is public accounting related, we have a directive, we had a piece of legislation on fiscal frameworks, which deals with the minimum standards in public accounting systems for producing government finance statistics. So in a way, what we try to do is make a link between the sources of information that are available and the government finance statistics that are produced from them. Next slide, please. So to give a bit of a flavour of the EPSAS discussions on consolidation here in the EU, the starting point for our discussion is always the IPSAS approach to consolidation. I mean, in much of the IPSAS work, we look to the international public sector accounting standards, and we discuss them. And as Ian has very well just set out what's there, I just wanted to mention some issues that come up when we discuss that in Europe. The first one, of course, and the one which I think you'll be talking about a lot during your discussions in this meeting, are the treatment of public corporations, or SOEs. And indeed, a lot of debate in Europe about the burden of consolidating them if you use the control approach. And as we'll see later, many EU countries are looking towards an equity approach, so not a full consolidation of the SOEs, but an equity approach as a way of finding a compromise between the level of difficulty and cost in the full consolidation, but also the need to ensure that these SOEs are represented on the consolidated balance sheet somehow. There's also quite considerable debate, and I'm sure you also have thought about it yourselves, which is what do you do when you have public banks and other financial entities? And public banks can include the central bank, of course. And here, again, quite some debate about what to do. because these types of entities have such a huge financial balance sheet that bringing him into a consolidated set of financial statements overwhelms other entities that may be there that don't have financial aspects as their core business. So again, there is a lot of debate. Should public banks be treated a bit differently? But not just banks, other financial entities such as public insurance companies, etc. Then there's very much a debate in practice, and I think you will see this, the treatment of the small and less risky entities. So what do you do when you're looking through the full range of control that an entity has of other entities, and some of them are small and less risky? What do you do? Do you force the small and less risky entities to really join the party and do everything, or do you give them some relief? I mean, this is not specific to consolidation, of course. This is actually a broader idea of how to deal with small and less risky public entities. But in consolidation, it has a sort of practical crystallization. There's also quite some debate about whole of government accounts. And I would say within Europe, there are a few countries who have pursued whole of government accounts, or most of government accounts, as some of them would say. But indeed here, we've decided in the EPSAS project that this won't be the first focus of interest. That means I think it's important that we walk before we run, and very much whole of government accounts can be seen as running. And so we have said, let's concentrate on the more important basic implementation of accruals accounting, and then whole of government accounts may come at a later stage. And indeed, for some EU member states, whole of government accounts is a pretty scary prospect. They certainly say that. All of the kind of background to the EPSAS discussions on consolidation you'll find in our EPSAS issues paper. There's a link in the slides, but also you simply have to go to Eurostat's EPSAS page, which is easily found on Google, and you'll find all of the papers there. So I would like to just go through a little bit on how we see the situation on consolidation. Very recently, we have actually made a sample study of 9 EU member states. We took a broad range of EU member states in different statuses of implementation of accruals accounting. And we asked them, in quite some detail, what were their practices, what they felt was important, what was not important. And in the next couple of slides, we'll have a look and see what we found. So first of all, in terms of consolidation practices or overall principles, you see here sort of 3 different cases. The first case is consolidation based on control. So you could say IPSAS. And here, for example, Estonia and Cyprus are these good pupils in terms of following a full control approach. You have consolidation based on judicial decision. That
Next
means
slide,
that
right?
There's
Next slide, please. Thanks you. Sorry, John. Yeah.
Sorry. So there's a law which says, okay, these are the entities which will be consolidated. They may not match exactly what the definition of control is, but you have a law that specifies that's the boundary for your consolidation. And finally, because in Europe, government finance statistics are seen as so important, you have the example of Belgium, where actually they use more statistical principles to consolidate. So they wouldn't say they're using the IPSAS 22, the IPSAS on general government that Ian mentioned, but they would use the perimeter of general government and try to find a way of consolidating within that. So we have these different models of what's there, all the way from pure control approach through to a more kind of statistical approach on top of the public accounting. The other interesting thing from the survey actually was around half of the countries that we looked at were using what we call sub-consolidation approach, which means they consolidated step by step. So imagine you have an overall controlling entity of a group, and then you have a series of sub-entities that control each other. So you have a kind of different levels of control, you could say. Some countries consolidate step by step. So they make the first consolidation step, then the second, then the third, and all the way to the top. About half of the countries, though, apply direct consolidation. So it's the top entity just collects from everybody and then they sort it out. So this was quite an interesting finding. Indeed, it's unclear which is the best approach. Countries said that it worked for them. So it's not clear whether one approach is better than the other, but it was something that we hadn't really thought about, and it's something which is a very practical aspect of how to do consolidation. Then we have the question of the equity method I mentioned earlier. So this idea that you don't make a full consolidation and bring everything in, but you actually have an equity method used for credit institutions, for example, in Spain, and also in Austria, France, Latvia, Lithuania, and Sweden. So quite a lot of the 9 countries we specified, they were using equity accounting or equity method for the commercial public sector entities. So what we see is a very wide range of the equity method actually being used, but again, selectively, rather more for commercial or for credit institutions, banks, etc. The other aspect that we looked into was materiality. How do we handle, and this comes into the small and less risky entities, how will countries in practice manage the materiality? And for example, we found in Cyprus that any entity that was less than 1% of a kind of 3-year average of central government expenditure would be allowed to stay on cash and provide basic consolidation information. So here, I think that the idea is to relieve the smaller and less risky entities. All countries provide harmonized reporting templates throughout their public accounting chain. I mean, this is really good because they make sure that they have a very ordered process for this, and quite often they're linking to common charts of account, which was actually mentioned earlier as well, and having detailed instructions for group entities. Now, we had a recent expert group discussion last week, actually, and there'll be a document on our website if you're interested to go and have a look. In terms of consolidation in GFS, so turning to the statistics side, it's clear that most government finance statistics data are presented consolidated. It's actually rather rare to find unconsolidated government finance statistics, certainly in Europe anyway. And Europe follows the same approach as in the worldwide GFS standards. So it can be very highly relevant for the debt, expenditure and revenue measures. And when you have these control targets or these control measures, you have to be very specific about how you make the consolidation within the statistics. So, for example, the Maastricht debt measure is fully consolidated for general government, for example. There are specific rules on what to consolidate for expenditure and revenue. So if you have control rules based on the level of expenditure, then you have to specify exactly what do you consolidate, because that can have an impact, of course, on your aggregate level of expenditure. And Eurostat has a process of checks on consolidation practices in statistics. So we basically visit countries and we check. Now, you can see the kind of impact that may have. In some countries, for example, for general government debt, the impact can be pretty big. You can see here that, for example, Greece, Spain, Cyprus, and then to a lesser extent, Latvia and Portugal, have reasonably big impacts from debt consolidation. And that's because, of course, different levels of government hold the debt of other levels of government. So here, I think it is important to understand that for some countries, it is significant impact. For other countries, less so, but these are still closely checked. And in my last slide, though, what I'm going to talk a little bit about is the challenges that one may have with consolidation, because in a sense, as a statistician, you would think that statisticians would very much welcome consolidation. They would say, well, our GFS are consolidated, and the public accounts are consolidated, and this is all wonderful. So, in fact, the statisticians should be really saying consolidation is the best thing ever, and we really are very happy with it. It does create some challenges, though, I think. And I think the fact is that the boundary of consolidation and the way that's consolidated, of course, is not identical between public accounting and statistics. And here's some examples. You can have a group which consists of both general government, so statistically relevant units, and non-general government units. And these, of course, have to be separated. And if you're dealing with consolidated data already, you can't break it up. So you have to go back a step, deconsolidate, and look into the more detailed accounting data. Similarly, to find out the impacts of the concept of control, where control brings in public corporations, state-owned enterprises, again, we have to think very carefully about how that impacts and what kind of data we can take for statistics. And the level of consolidation by transaction may be different. So whereas some transactions will be consolidated in public accounting, in statistics, we do not consolidate them. And that means that, again, we have to remove that step. And finally, materiality levels. Clearly, in statistics, we want to gather everybody, whereas maybe in public accounting, as we said earlier, small and less risky entities, even though they don't make up a big proportion of the total, may have some relief. So all of these things means that any statistician must understand how the public accounting consolidation is done and really discuss very closely with public accountants how to use the data. And of course, ideally, you have access to the budgeting system, you have access to the detailed information pre-consolidation, and that means that statisticians can just take what they need. But I just wanted to bring that warning in a sense. And I think I'm now on the final slide, which is the thank you. So thank you very much.
Thank you very much, John. You can see here probably applause from the people. Thank you for very interesting and insightful and very practical approach. As I expect a lot of questions coming to you as well. Sache, please give us the IMF GFS perspective. Thanks.
Thank you very much. Firstly, thank you very much for the invitation to be here. Good morning, everybody. It's a pleasure to be here. As those of you that know me well probably know, the GFS is my love of my life, besides my husband, of course. And harmonizing GFS and accounting is my passion. So I think it's very nice to have those. But in consultation with my colleagues, we have decided that for this session, I will talk rather primarily focusing on the macroeconomic perspective of consolidation of subnational government, because this session is supposed to focusing in a little bit about subnational government. I would be looking at the relevance of consolidation of the subnational government, just to put that into perspective. I would like to share with you a little bit about the impact of subnational government on public finance management in general. And lastly, I would like to talk a little bit about the challenges that we quite often see with consolidating subnational governments. And also share with you some of the tools that, in my experience working with many countries, we have discovered that it could be useful. The relevance of consolidation of subnational government is largely determined by the level of decentralization in countries. We see that countries can have different arrangements with regards to political, administrative, or fiscal decentralization in countries, and it really differs from country to country. Different allocations of powers and accountabilities for services may exist. In one country, the education services may be executed at the central government level, while in another country, that same type of service is executed at the subnational government level. There's also different arrangements with regards to the funding of subnational governments. In some countries, subnational governments are largely funded by transfers from the central government, whereas in some other countries, subnational governments may have some authority to collect particularly type of fees or even taxes. So the level of subnational government powers to raise revenue differs from country to country. We also see in countries different levels of powers to borrow. In some countries, local governments are totally prevented from borrowing themselves in their own right, where in other countries, local governments and other subnational levels of government do have powers to borrow. In some countries, those powers are limited by some kind of fiscal rule, but the circumstances do differ. Managing and measuring the economic impact then of subnational government, therefore, really requires us to look at subnational governments firstly from a control and fiscal oversight perspective. There should be a look at those subnational governments at an individual level. In many countries, there's some groups or regional groupings of subnational government that may need some monitoring from a public financial management perspective. And for finally statistical purposes and having a view of the whole of the general government, we also need to have a view of all subnationals as a group. Of course, subnational governments can also exist at two levels. You can have state type of levels or provincial type of levels, and you can have also then the level of local governments or municipalities. A review of the impact of those subnational governments on the finances of the central government is extremely important to manage and oversee the risks coming from those central governments. And I would like to emphasize that because of all the reasons that I have just explained, the only level at which you can really compare one government to another government is to look at the general government level. So the level of decentralization and intergovernmental fiscal arrangements between countries will therefore determine the importance of consolidation in various countries. For example, if you have a country in which there's large transfers through some kind of revenue sharing arrangement versus a high level of self-reliance, the level of consolidation or the impact of consolidation on your financial accounts will be higher. Because if you have a government that is heavily reliant on transfers from government, the size of the consolidation in your numbers will be very large. If you then don't consolidate that, of course, you will have a large overestimation of the size of your general government. It also depends on whether these transfers are conditional or whether these transfers are unconditional. Because where you have a conditional transfer, the transfer will not go out as expense for the central government, but rather as a transaction in financial assets and liabilities until such time as the conditions have been met. So the type of transfer will also have an impact on how and where the consolidation needs to occur. We also have in many countries arrangements where there's on-lending to subnational governments. In other words, the central government retains all the borrowing powers, and that the proceeds of the borrowing is then on-lent to either one or multiple subnational governments. And those on-lending transactions can also or should also be subject to consolidation. And where we have governments that extend explicit guarantees to the borrowing of the subnational government, the moment that there's the issuance of the guarantee, that does not really impact on consolidation because there has not been any specific transaction at that time. However, if a call is made on that guarantee and the government actually need to step in and help the subnational government out with a payment on that guarantee, of course there will also be consolidations that need to be considered. The last item is quite controversial in the sense that we quite often see in countries that there's also some implicit guarantees that may put pressures on government for bailouts. Let's think about the example if the health services in your country is being executed at a subnational government level. If that health sector is in financial trouble, government has no option but to bail them out, either through extending an additional loan to them or making a big transfer to them. The other difficult problem with these implicit type of guarantees, if those subnational government levels are responsible for execution public services, those public services need to be continued, and it creates almost like a political risk to government to not continue those services. So this implicit kind of guarantees that exist between a central government level and a subnational government level creates quite often transactions that need to be subject to consolidation. If we look at the consolidation of governments, I would like to emphasize that consolidation by itself is not the end, but it's a mean to the end. What do I mean by that? Consolidation increases the institutional vision that the government have over their finances. And because government now has a broader vision of the financial condition of the country, it allows them then to take better policy decisions. And I would like to emphasize that all of this is related to those policy decisions. Government at a central level where they have oversight about their, on their subnational governments have no option but to have measures to control the decisions that they take with regards to those subnational government levels. Consolidation of subnational government also allows an analysis of the fiscal risks coming from those subnational government. And this is the most important thing, because fiscal risk in a subnational government in many countries have already resulted in actually a changeover in the government in that country. Subnational governments should include all the non-market activities of the states, the provinces, and the municipalities, and if needed, you have to have those groupings of consolidations to have an oversight of each of the levels of government in the country. But I also want to emphasize that in many countries, subnational governments also create state-owned enterprises that they themselves are in control of. And if that is the case, a subnational government accounts should also have a view of what is happening in those state-owned enterprises that are under their control, because even in those enterprises, some fiscal risks can emanate from poor management and finances in those entities. And when we talk about fiscal risk here, I want to emphasize that we talk about all the kind of uncertainties that may cause fiscal outcomes to deviate from the planned outcomes. And those fiscal risks can come in many forms. For example, macroeconomic shocks, like the macroeconomic shock that COVID created in many countries, where we had price and demand shocks just going right through the economy. It could also come from contingent liabilities, as we've already explained. And this contingent liabilities could be very significant. In a study that was conducted by the IMF, and unfortunately I don't have more recent data, but a study conducted between 1990 and 2014 has indicated that contingent liabilities of subnational governments ranged between 3.7% of GDP through to 12% of GDP. Now, if with the deficit and debt rules that we have in Europe, if you have a contingency of 12% that all of a sudden need to be made, a payment need to be made on that contingency because the guaranteed loan has been called, you can see how significant the impact of those risks can be for government. Also, what we have seen in the work that we do on fiscal transparency in the IMF is that in terms of our fiscal transparency code, we require certain practices from subnational governments. Firstly, we require that subnational governments should at least have some kind of annual reporting in place. We require that for a good practice in subnational governments, they should have the annual reporting in place, and they should have some kind of limit on the borrowing of the subnational governments. And for a very good practice, we require that countries have the annual reporting, they have the limit on borrowing, as well as some quarterly reporting, so that government can use all of that information for fiscal oversight. Unfortunately, in terms of the 41 FT fiscal transparency evaluations that we have conducted, we have found some very not so promising practices at subnational government level. In 7 of those 41 countries, we have found that there is no annual reporting, or the annual reporting is so late that it doesn't help government at all to have an oversight of the finances of the local governments and to manage the fiscal risks coming from those local governments. In another 12 of them, we did find annual reporting that was very good. But the one that I want to focus on that creates a lot of risk is that only in 50% of those subnational governments, there was actually some limit on borrowing. And that is where, of course, a lot of the fiscal risks come from for the national government. So if there's poor revenue performance, poor expenditure performance and expenditure controls in those countries, there could be a large pressure on government to actually increase transfers to those local governments or bail them out in the forms of loans or guarantees that they issue to them. And again, all of these risks are being aggravated by the implicit risks of local governments or subnational governments. Governments can just not allow them to completely fail and cease all their service obligations. The impact of subnational governments in consolidation, it allows us to manage the fiscal risk from subnational governments. It should first start with a process of assessing the risks and quantifying those risks coming from subnational governments. And that can only be done when you have a full set of consolidated information on your subnational governments. That will give you an indication of what is the total amount of risk that you as a central government is exposed to. Governments could then subsequently, once they know the risk, they can actually make provisions for mitigating those risks, take some steps to mitigate the risks, or if necessary, they can make provisions in their budgets to actually deal with the payments related to those risks. And as a very good fiscal transparency practice, of course, we always recommend that governments make sure that they disclose all the type of risks that they are exposed to. Analysis of the fiscal risk of subnational governments could inform us as a government to take various type of steps. In some countries, we see that they put in place much stronger regulatory frameworks around subnational governments. In some of the governments in which we have, for instance, done the fiscal transparency evaluations and found that there was no cap, those governments then realized that it will be a good thing to put a cap on borrowing of subnational governments. And those caps are quite often related either to the power of the subnational government to actually raise their own revenue, or it is limited to the type of, the nature of the expenditure the government can borrow for. For instance, in many countries, a subnational government borrowing is limited to borrowing for investment in non-financial assets and infrastructure. It could also help us, once we know what we are exposed to, it can help us to actually improve our reporting requirements. And unfortunately, in many countries, that happens only once a shock event at subnational government occurred. Once the government is almost bankrupt, so to speak, then the government realized we don't have enough information on those governments, and then they implement better reporting requirements on those subnational governments. And it allows us also to enhance the oversight, central oversight of local governments when we have the information available. And at the last resort, governments really need to step out in with direct measures. And we have seen in some countries where governments actually had to put subnational governments under the administrative oversight of a national government entity, just to try to rectify the financial hardship that those subnational governments are in. Challenges for consolidation. I think my the two previous speakers already alluded to some of these. The first challenge that we have in many countries is the level of independence of subnational governments, which then result in separate accounting systems, separate financial planning systems, and so forth. And quite often, because of this independence of the local governments, which in some countries is even in constitutions of the governments, quite often then central government has got less control or less insight into those sub-government levels. In those cases where you have these local governments with separate systems, what we usually recommend countries to do is to implement a system according to which there's some standardized reporting formats from the central government to those subnational governments. Those standardized reports can then be uploaded into either systems, or in many countries it is just sending in the financial statements on an Excel spreadsheet or the financial statements in a PDF format, but at least the government get that information. I recently worked in a government where they have created an electronic system as digitization in governments improve. They have created a digitized system in which financial results of local governments can directly be uploaded into the digitized system. Accounting standards applicable to subnational governments does not prescribe standardized classifications of all the operations of these subnational governments. As you know, accounting standards provides us with some guidelines on what to be reported, but it does not require specific standard lines of reporting, except for in some cases like interest and so forth. If government then want to consolidate the results of many of these units, it will be important to actually have information that is prepared in a similar manner. Otherwise, the aggregation and consolidation of those information becomes very difficult. And in this regard, again, I think one of my previous speakers also alluded to the fact that one of the best solutions that you have there is to actually use the GFS ESA, SNA, System of National Accounts type of classification structure to implement a standardized classification requirement for those entities for their reporting. Very important for consolidation, when you think about setting up how to classify transactions, is actually identifying the counterpart to a transaction within your accounting system. That can be done either in the integrated or multi-dimensional chart of accounts, where you have in the structure transfers to local governments, and you may even want to identify the various type of local governments that receive those transfers. Or otherwise, in a multi-dimensional chart of accounts in modern IFMIS systems, it's also possible to use an administrative classification and to identify the recipient of transactions by using that administrative classification that you have built into your chart of accounts. Of course, the first price for local government or subnational government consolidation is if all the general government entities can be using the same information management system, and if they could use a standardized chart of accounts. And that is a movement that we have seen in quite a number of countries, not only here in Europe, but also in other parts of the world. Other challenge that I would like to mention is the size of subnational governments. They are often large in numbers, depending on the size of your country, and the value of them differ from very small local government units to very, very large local government units. And here I would like to encourage again that the principle of materiality should guide your decisions on what to do with these local governments. We have found in the work that we have done in many, many countries, almost 80% of the value of subnational governments is presented by only a few of the larger national governments. That does not mean that you should not keep your eye on the smaller ones, because if you have accumulation of fiscal risks in many of the smaller ones, the impact of that on the government finances can be just as big as fiscal risk coming from a large entity. For that consolidation then, we suggest that you look at materiality from an institutional point of view. In other words, which local governments is really material and should be consolidated regularly. But you also need to look at consolidation materiality with regard to the type of transactions that you consolidate. Because there's some of the transactions that's so much larger in size than others. Rather spend your effort on identifying the large transactions and intergovernmental relations to be made subject to consolidation than trying to figure out exactly what kind of small purchase was made between two local governments, for example. And the last challenge, I think previous speakers also alluded to the fact, is that the accounting definition of control does not apply to subnational governments, and therefore, from an accounting perspective, you will not find a consolidated account for all your subnational governments together because they don't control each other. However, from a reporting point of view and from a public financial management point of view, it is very important for you to have that view of all your subnational governments together. And in that regard, we recommend you to think about the statistical principles of sector classification. Use those principles to first define which entities are under the control of government, which then define the boundary of the public sector. Once you have defined the boundary of the public sector, you need to decide within that boundary then which entities are market entities, which should go into the general government sector, and which entities are non-market entities that should go into the public corporation sector. And once you have your general government boundary defined, then the principle of political influence need to then determine which are the central government, subnational government, and even within subnational government you can have different levels of subnational governments that can be made subject to consolidation. So in conclusion, subnational government consolidation is essential to have a comprehensive macroeconomic fiscal analysis of the whole of the government. Subnational governments expose the central government to significant risks, as I have illustrated, that really need to be appropriately managed by government, and for that reason it's very important for you to have that information about subnational governments available. And lastly, there is many challenges remains with regards to subnational government consolidation, but there is some tools that can be used to overcome those challenges. And of course, I'd be happy to speak to anybody about those tools some more. Thank you for your attention.
Thank you very much, Zahe, for a very informative presentation, sharing your experience and very practically tackling a number of important aspects. I expect a lot of questions or important questions will be coming from the audience. Now we can open up for questions. John is also connected on video. You can raise questions to John. Yes, please go ahead. The mic? Yeah, you have it. Just you speak up. Говорите, не должно быть.
Можно говорить?
Irma, which 4? English is number 4.
If I may. Thank you very much. I represent Ukraine, the Minister of Finance of Ukraine. I would like to thank all speakers of this panel for us this information which you have presented and those issues that you covered today. And the most important, the answers that you gave today are very important, because in Ukraine, consolidation of financial reporting at the level of government is performed since 2019. We have consolidation of local budgets, state budget, and the budget units, and this is done at the level of the Treasury using the software product. At the moment, what we are working on and why this information was very important for us, first, we have almost finalized the diagnosis based on PULSAR program, which was mentioned in the beginning. We evaluated the level of our system of accounting in Ukraine. This is very important. At the moment, we work on improvements of the process of methodology of consolidation and the answers that you gave to us for the questions, because we had those questions when we traveled to this conference. These answers are really important for us. And now I have a question which is not so much about consolidation. We have ongoing discussion of what is the reporting that should be confirmed by the external audit, because we understand that the consolidation can be done according to the methodology by the accounting services. We have discussed that consolidation, for example, for determination of foreign debt is performed by the State Statistical Committee at the level of the statistics, but we need to understand how correct are those indicators, especially this is true for the indicator of the local budget when we have active decentralization process, when we have different local budgets in terms of size. We need to understand who and how should perform this control. We have ongoing discussion there. Supreme Audit Institution should perform control of consolidated reporting overall for all budgets. This is the opinion of the Minister of Finance of Ukraine, for example. We are supporters of this position. Or we have the audit of the reporting of the government only. If possible, could you answer this question? And thank you very much once again. Thank you.
Very good question. Jonas, you are connected on video. Would like to go first to react? And the question is Supreme Audit Institution, or what they are going to audit? The central government, the whole of government, financial statements, or GFS reports?
Thank you for the question. Yeah, it's extremely relevant. From the statistical perspective, it's very rare that official statistics are directly audited by an audit body in a country, at least in Europe. The statisticians operate on a professional code of conduct basis. We don't see auditors coming in every year or every quarter or whatever and checking what the statisticians are doing and providing an audit opinion. What we tend to see is that we have a combination of professional oversight, which means in effect Eurostat visiting the countries and checking what they're doing and verifying and so on, which is not at all an official audit. And at the same time, from time to time, the Audit Institute nationally might make an audit of the system to prepare the statistics. So not actually auditing an individual set of statistics every quarter or every year, but they may occasionally come and have a look at the overall system for generating those statistics to see whether there are checks and balances there, whether there are serious controls, whether the quality of the data input is there. But of course, if statistics are then subsequently being used in a public accounting statement document, then of course it may come within the purview of the audit institution, but normally not directly to the statisticians. Thank you.
Thank you, John. Ian, and then Sachin.
Yeah, thank you very much for the question. I think it's very important, and actually, I think the role of the auditors, whether that's the Supreme Audit Institution or other audit bodies at different levels, is sometimes neglected in terms of thinking about the the successful implementation of the reforms. And I would say, very much from personal experience, it's really crucial to have those discussions with your Supreme Audit Institution and other levels of audit early in the process. And I think, we've talked very much about consistency in terms of accounting frameworks and principles, but I think you also need to plan early in terms of how will sufficient assurance be gained in order to provide an opinion overall on the consolidated accounts. And certainly that was a challenge that we experienced in the UK, because we had different statutory audit bodies for different parts of the UK. We also had different audit arrangements at a local level for the municipalities. Compared with the top level, we had the involvement of private firms on a contract basis for some bodies. So it was very important to think about those relationships. What was the nature of their reporting in terms of, was that compatible with an overall opinion? And then how would that all come together? So I think, it is really important to think that through, and to make sure that the legal framework that you have for the reporting also will work. So that was another part of the preparations that we had to put in place when we put the legislation in place to provide for the consolidation. There was a specific part of the legislation that addressed the audit requirements to enable the Controller and Auditor General in the UK to be able to express an overall opinion, and also that gave him the power to actually have appropriate conversations with different auditors throughout the system. And again, at that stage, that was actually something that was quite sensitive because of the relationship or because of the legal status of municipalities compared to central government. So the Supreme Audit Institution did not have access to municipalities, but we needed to make sure that there was appropriate provision in terms of the conversation between the auditors. So that, again, was also something that we had to work through, but we had to work that through right at the beginning, and then to work on the relationships and the appropriate provisions throughout the process.
Thank you.
Thank you.
Yes, it's on. It's always on.
It's always on. Thank you very much. Thank you very much for that question. Very interesting. The first thing that I would like to say is that there's a very, I fully agree with John that statistical data is usually not subject to audits. So that's the first point. The second point that I would like to make is the importance of actually reconciling statistical outputs with the inputs that you have received from your accounting statements. And again, in terms of the Fiscal Transparency Code, from the side of the IMF, we encourage countries to always produce and actually publish a reconciliation between what is reported in the statistics compared to what is reported in the audit reports. The second comment that I would like to make is that in terms of whether consolidated accounts are being audited or not, the examples that we see through many country work that we have done is that it quite often depends on the maturity of the accounting reforms in the country. Usually, the process starts by requiring the audits at the entity level, But as the system matures and as the legal framework adapts to require consolidated information on either the central government or the local government or the provincial governments, that legal framework may change over time because of the maturity of the system in the country. And in those cases, quite often then the required audits of those consolidated statements are also added to complete the full framework of accounting in the country.
Yeah, thank you, Sache. Just a few points on my side, just because, as it was indicated by speakers, we have a few layers. So Supreme Audit Institution audits the reports which are for general public and for the parliament. So they are just validating the information, and statistical information is, I agree that, and we are on the same opinion that this is not audited. We have different, even in this room, we have different countries with different legal mandates for Supreme Audit Institutions. Some cover municipalities, some do not cover municipalities. The important is which level to audit. It's a consolidated financial statements which needs to be audited, because the opinion is important for the whole of government operation, not only on subsectors. There can be information disclosed on sectors, but or subsectors, but the important is to have bigger picture of how government operates, what is government financial position and performance, which is important for the parliament and for the public. Another element is very important, and we discussed 2 weeks ago in Tashkent, in PEMPAL event, is the role of internal auditors, and they have a key role to play with the public, with financial reporting reforms, specifically looking into the processes, systems, and how the financial reporting is prepared, and how reliable internal controls over financial information, and they are also should be our advisors in this process. So yes, this is another layer we need to work with and collaborate. Internal audit, yes, and Supreme Audit Institutions, yes, we have many countries in this room and outside that we have delaying audit of the financial statements, leaving the progress to be made on the financial report, as Sacha said, like maturity, but that's also, we sometimes need Supreme Audit Institution to do an audit and to help us just to push the reform forward, even if we are not ready enough. Very good question, thank you very much. Questions, I can see, yes, please, and then Hovannes, yeah.
Gruzia,
the State Treasury of Georgia. I have a question about the state entities. As of January 1, we make the transition to provide treasury service to the state enterprises. We have developed a system for state servicing, 350 state entities. They will be using GFS for budget classification based on the sector classification, and they will be also providing a quarterly report to the Ministry of Finance. And what our speakers have stated regarding the potential risks, we will address this challenge. But as far as preparing consolidated financial statements is concerned, they will not apply GFS. They will operate on the basis of the private sector standards. They will operate as a budget organization. They will remain as private organization. What is the approach to be used to consolidate them, to reflect the considerable degree of consolidation in the preparation of financial reporting to the government? We are currently studying this methodology, but I have a question. When they will make the transition to the Treasury service, and what kind of information can be disclosed in the preparation of the financial reports? Do we have to disclose this information? And in the course of consolidation, we would like to know more about the direct consolidation method. Should it be at the level of the government or at the level of industry ministries? What is the best approach? Should we make these enterprises adopt IPSAS, Or should there be a transition stage so that they embrace financial reporting with some elements of IFMIS to develop some kind of a transition methodology? And are there any plans to develop uniform standards for state enterprises based on IFMIS? And is there any kind of a methodological manual where all these ideas are addressed, where we can obtain information, which approach to use, and how to develop this information in developing consolidated financial statements to ensure a full consolidation of state enterprises? At present, when we disclose financial reports, we, of course, reflect the information about the share of the state, but as far as other indicators, we don't have this information from the state enterprises. And they do not provide financial reporting to us at the Treasury. Consequently, as far as financial reporting is concerned, it is incomplete. We are aware of that. And what is the attitude of PULSAR in assessing this? What is your recommendation when all this information is not contained in the financial reporting for the state enterprises? I am referring to the state enterprises, and I would like to emphasize this, that are under state management, which is specified in the appropriate legal framework, and they are defined as state enterprises. But I would like to emphasize that they are not budget organizations. They remain state enterprises. Thank you very much.
Ответьте мне на coffee break.
Ну, я думаю, что уже время перерыва, и не поймут, если я сейчас вопросы
Давайте
задам.
вопросы.
Да.
Давайте.
На потом я буду.
Хорошо. Good. So then there are a few questions about, yes, it's about director chain, which will probably, of course, John will also react. So do we provide an advice? How to do with state and non-commercial organizations which follow IFRS? And in many countries we can see that they are following IFRS and for decades. What to do with them? And on PULSAR we'll have separate discussion and disclosures in this regard. Please, Ian.
Yeah, I think that was an extremely good question, and it is actually one that certainly in terms of the ability to consolidate state-owned enterprises when you're preparing an IFMIS-based consolidation that we hear asked in many countries around the world. And firstly, just to say that there is a very good summary staff question and answer on this matter on the IFMIS website, precisely because we've been asked this question. So in terms of applicability of IFMIS, clearly that's a matter for decision at a national level, but generally for state-owned enterprises that are operating on a commercial basis, IFMIS are not intended for them. You know, we would expect that they would be reporting on an IFRS basis. In terms of the interoperability, if I can call it that, of IFMIS and IFRS. Because of the way that IFMIS are developed, we have a formal process where if there is an applicable IFRS, that is used as the basis of the equivalent IFMIS, and the consolidation standards that we've been talking about today are a very good example of that. We may change terminology, we may add additional examples that resonate better for the public sector, or we may adapt. But fundamentally, therefore, you have an ability, because of that common root, if you like, you have an ability to consolidate IFRS information into an IFMIS consolidation. And I've seen that in the UK, that works in practice. I think you make a good point, though, in terms of your information system will be based on GFS. So it's very important that the choices that are available within within the IPSAS standards and IFRS, actually that those choices are made with a view to maximising commonality with GFS principles and requirements. So one of those things that you will need to look at is actually getting consistency across those state-owned enterprises in terms of the choices that they are selecting, where you haven't got a common approach either available through a choice under IPSAS or IFRS, or they're not using the same approach. Then you will need to they will need to collect two sets of information in order to be able to do the consolidation under IPSAS, but also to collect the GFS information. And I think that's where the PULSAR publication on charts of accounts will be helpful in terms of identifying where those differences are. In terms of the practical question that you asked about whether you should get state-owned, the ministries to do the consolidation, or you should do that at the centre, I think, I suppose based on my own experience on this, actually my preference would probably be for that to be done by the ministries. Now, there are some issues in terms of levels of resourcing at the ministries, but actually as they are the ones that have responsibility, at least policy responsibility for all the various different bodies in a sector, then I would argue that they should actually have the relationships and also likely budgetary responsibility as well. So therefore actually making them responsible for the sub-consolidation should actually strengthen those relationships. And just to share with you an example from what happened in the UK. Originally the budget relationship was just with the ministry. They didn't have a consolidated budget for the area they were responsible for in terms of the various statutory bodies within their areas and the state-owned enterprises. Actually, once we'd implemented consolidation, they changed, the budget framework was changed, so the budget also operated on that consolidated basis, which again I think strengthened the control that they had. So personally I would see that pragmatically that would be a good approach to adopt. That's not to say you can't do the consolidation centrally, but if resources are constrained, and certainly we had that challenge that we only had a team of 7 doing the consolidation, then I think that also argues for actually you know, the sub-consolidation approach at ministry level.
Thank you, Ian. John, would you like to add or anything on your side? And then if Zacher would
thank you, Armin. Just 3 thoughts. I think the first one is I'm a big supporter of appropriate accounting standards for the body that you're applying them to. So I think that when you have commercial enterprises, then indeed it is the choice of most jurisdictions, if not all, to move more towards commercial accounting standards, whether IFRS or commercial GAAP or something. I do just stress that some of these bodies, though, have non-commercial operations as well buried within them. So you have to be very careful to say, is this a commercial enterprise, or actually is this a part commercial enterprise and part something that looks more like a ministry or a government body making non-commercial work? So that's the first thing. The second thing is I think you need to decide how you want, as a government, how the government wants to operationally monitor and control the state-owned enterprises. So I fully agree with Ian that where the accountability for a state-owned enterprise is with a particular ministry, then it is far better to have that ministry responsible for dealing with that entity, not just for its policy, but also for its financial situation as well. So definitely from an overall perspective, and we see this commonly in Europe, it's the ministry that individual ministry takes responsibility for the SOE. There are a few European countries where the government has decided that all SOEs will report to one particular ministry, in which case there is indeed a centralisation anyway. I think the third aspect is you mentioned the GFS data and what's needed. Clearly, government can create templates, standard templates and instructions that can collect data, not just from the public accounting perspective, but also from the GFS perspective. If they're linked in a chart of accounts, this works well. But as we saw for European countries, some of them choose not to apply a full consolidation for SOEs, but prefer to apply more of an equity approach. Obviously, that means you're not consistent with IPSAS, you're not following IPSAS. And indeed, that's a choice you have to make. If all the information you're collecting is useful for monitoring the SOEs, for risk analysis, and so on, then it's worthwhile doing it. If the control of these SOEs is a bit lighter, then you may feel that that's not appropriate. Thank you.
Thank you, John. Saheb, would you like to react? Yeah.
Just briefly to say that I think the reporting lines would need to be determined by whether you follow a centralized or a decentralized ownership approach to your SOEs, and the responsibilities with that ownership policy for reporting should lies then with either decentralized or centralized, depending on the policy and the legal framework that you have in place. Having said that, though, the Ministry of Finance remains responsible for financial oversight, which includes financial oversight of the SOEs. And therefore, as a Ministry of Finance and in that responsibility of exercising financial oversight, it remains important that you either have the consolidation dated financial statements or otherwise have financial reporting by the SOEs or by the oversight bodies of groups of SOEs.
Thank you very much. It was a very good question, Zura. But I think the question is also on the difference, or it's about non-commercial organizations. How would we do also? That was some aspect. And I think the reaction is that if it is non-commercial organization, ultimately you need to move towards IPSAS. And those are which are commercial SOEs, they need to follow with IFRS. So SOE stays with IFRS. Those are non-commercial. Ultimately, for the purpose of the standards, there will be moving to the IPSAS. And very good reaction on the direct on versus chain consolidation. I think the message is consistently is you need to link to the accountability. If the ministry is, or agency is accountable for SOEs and their performance is assessed based on the sectoral or SOE performance or NCO's performance, non-commercial, then you there is a logic to consolidate on the chain level instead of the direct at the whole of government level. And of course, after the coffee break, we will have more opportunity to discuss. And I would like just to thank panelists and most important, John, for joining virtually, and thank you for a very great and interesting session. Thank you. Please, let's come back 20 minutes past 11, 20 past 11, Austrian time. Thanks. Whoever read yesterday's Financial Times, you probably saw Doug's article in the Financial Times on the topic of accounting. And who is Doug Detter? Doug is considered to be a doctor, not a medical doctor, but a doctor of who is unblocking the public wealth. And Doug is also a president of Saturn, the Swedish government holding company, and is a very well-known professional in this area. As Doug says, without accounting background, but he makes a major impact and changes. Doug, the floor is yours, please.
Very good. Hello. I'm going to talk briefly about this book, and then I hope we can have a conversation, and I'm sure you have a lot of questions as well. The topic is really why you're all sitting here today, and why you are working with this extremely important topic, in my view. And I hope you feel the same after this session, and that you're able to convince the people in your life and in your government why you are spending so much time with all these details. At least I am struggling. When people are asking me, what am I doing? It takes a while to explain. So I am spending a lot of time trying to make this intelligible or understandable to people, because if we don't, this book is written by 5 people who have come together with some 30 years of experience with public financial management from completely different angles. So Ian Ball should be well known in this hall because he is the architect, one of the architects of the New Zealand financial reforms, and also one of the initiators of the IPSAS, and has been a chairman or CEO of IFAC, etc. So he is the accountant in this team. Willem Bouter is a well-known economist, chief economist of the OECD, Citibank, EBRD, etc. And then John Crompton is an investment banker, but also a UK Treasury official 3 times over. And then we have Jacob Soll, who is an economic historian, has written the history of accounting. And he basically claims if governments don't understand accountancy, they will fail. So your job is extremely important. In my view, the problem is that we take accounting for granted, and we really don't understand how important it is. I can just see it, my kids, they take a smartphone, internet as a given thing. But if you would imagine 2 companies, one using internet, smartphones, digital technology, and the other are still using written letters on papers, the efficiency of those 2 organizations are going to be immense. Oh, sorry, the difference in efficiency are going to be immense. And in my view, I hope you don't get offended, but a lot of public sector are still using cash accounting, struggling to move towards integrated accrual accounting, and that is pretty much the difference, because accrual accounting is probably the most underrated invention in human history. We all appreciate electricity, we all appreciate steam engines 200 years ago, etc., but nobody really appreciates accounting and what it has done for us, because it actually has created the wealth from the private sector that we all enjoy today. And the fact that the public sector has not caught up with this invention, which is at least 800 years old, probably 1,000, because it was actually invented in 900s in Persia, is amazing. So we're trying to answer the question why we should bother about this and why it is so important. And the answer is 4%. 4% of GDP. That is what any government or every government can gain by using proper accounting and proper management of their assets or balance sheet, assets and liabilities. That is the message of this book, and it will come out in a few weeks. And what you see here, most of the focus of, is this a good place to stay? Everybody sees me, yeah? Most governments are concerned, and most debate, I should say, most energy is concerned about the budget. In a developed economy, that's about half the size of the GDP, or the government sector, so to speak. Not really I call it the budget to be simplistic, but the government sector in a developed economy is around half the GDP. Less developed economies, it's much less. And in low-income countries, it's very small. But this is what we are concerned about. Instead of focusing on the balance sheet, which is 3 times GDP. And what we are trying to say is maybe we should focus on the balance sheet as well. Not only, but as well. And the other astonishing factor is, as soon as we talk about the balance sheet, everybody says, yes, we know that. We know about the SOEs. I was one of the architects of the OECD guidelines of SOEs 25 years ago. and which is, was fantastic in that day, in 1998, when we started this. But I have since almost regretted it, because I spent most of my life trying to restructure state-owned real estate and state-owned commercial assets or state-owned enterprises. But the fact that we call it SOEs is that we are missing the much bigger corporate entities and operational entities on other administrative levels. Because as you see, generally, corporates, SOEs, or whatever you want to call them, is a really small part of the balance sheet on the asset side. The big asset class is real estate, and we know nothing about it. In most of the countries that are sitting in here, probably 5 or 10% is on the books. The rest is hidden, mainly because of accounting, or only because of accounting, because we have a historical cost. We book them at historical cost and refuse to use market value, which is madness for any accountant in here or anybody with financial or private sector experience. That is absolute madness, complete madness. Because who was it? Was it Ian or somebody said if there's no number, it was Adrian. If there's not about climate, if there's not a number on it, if there's no price on it, it will not be. We will not get attention. So assets will never, or liabilities for that matter, will never get attention, or the price of climate change, or climate mitigation, or climate adaptation. If we don't put a price on it, nobody will react. And this is, you will be criticized for this, because people will tell you, well, that's fine to have that kind of accounting for business, but this is not a, government is not a business and all this. That's, sorry to be provocative, but that's probably my role today. That's rubbish. Because if we don't have a price on all these things, they will never get attention. I was an investment banker and then recruited into the Swedish government when Sweden was going bankrupt in the 90s to turn around the Swedish state-owned companies. Because it was a socialist government, they didn't want to privatize, so they want to find somebody in the private sector who had experience of turning around companies without privatizing it. I took that job and managed. I didn't spend one tax dollar and turned around 63 companies in 3 years. That created a model for the WorldBank and the IMF and all other IFIs around the world, how to do this without spending tax money. Because there's so much hidden in the balance sheet. And that later led me to look at the rest of the balance sheet, the real estate, the infrastructure, the liabilities, and hence this book. And to show you, this balance sheet is almost twice, or it is twice, the stock market in most developed countries. You can imagine what it is in less developed economies. It's huge. And thinking that those kind of commercial assets should not have the same accounting as the transparency, the visibility we have of the stock market, where everybody is investing your money, either as pensions or other assets that you need to use for insurance purposes, etc. It's not only rich people who are in the stock market, it's you. And not to have the same kind of financial accuracy and ability to manage on this balance sheet, it's madness. So why, if accounting or accrual accounting was invented by a Persian guy, actually who gave name to algorithm, because in those days mathematics and accounting was the same. It was taught in the same schools. The people who invented algorithm, or the guy who invented algorithm and accrual accounting was the same person, because these were two knowledges that were seen as parallels. And actually, there is a parallel, because in algebra, it has to be equal between the equivalents. Same thing with a balance sheet. And in accrual accounting, there has to be a balance between the two numbers. But managing government finances, over several hundred years was all right because it was mainly to finance war. And it increased the debt. Here is a chart from the UK, which is one of the few countries that have several hundred years tracked debt and public spending. And war always expanded the debt enormously. But at the same time, because the public sector was so small, probably less than 10%, it was very easy to pay down that debt. It was not until the late 1800s when Bismarck came up with the idea of public pension, and then after the Second World War with a welfare state. So everything has been driven by war in terms of public finances, very much. Because the welfare sector, you know, and voting rights, etc., has all been driven by the equal demand of asking the populace to fight in a war or to pay for a war. Then we suddenly created monsters, leviathans, that in developed economies are now at least 50 to 60% of the economy. They are huge. And it's no longer possible to manage such a huge balance sheet as such a huge financial mass, volume, just with cash accounting. To focus and then to have guidelines towards the public and towards the political debate that are cash measures like budget deficit or surplus and debt over GDP doesn't tell us anything. It actually tells us in the wrong direction. It leads us in the wrong direction. So on the G7, Sage is here from the IMF somewhere. Right, Sasha. Okay, sorry for pronouncing your name now. These are IMF numbers. They did an incredible job compiling all these numbers over many years, and 2018 published the Fiscal Monitor on Public Wealth. So I think you have more than 200 countries today, but yet we have focused on the G7 because the numbers are more plentiful and easier to analyze across many parameters. But even if we have a G7 focus, which are the most advanced economies, it tells us something where everybody needs to pay attention. And also, these are such dominant economies. So if they don't get their public finances right, it's going to spell disaster for the rest of the world, or for the rest of the world economy. But as we can see, it's only one country of the G7 that have a positive public net worth, which is, as you can deduct from the title of the book, that it is the fiscal measure that we think should take the lead. It shouldn't be the only one, but it should take the lead because it helps us to guide our public finances in a much better direction. But despite all this peace that we've had for 70 years, at least among the developed economies, we haven't managed to produce a net worth that is positive. And despite very low interest rates for the last 20 or 30 years, it still looks very miserable. And that is, I must say, a failure on the account of these governments. But also a failure because we've had the wrong fiscal measures. We are discussing fiscal measures in the EU, in the US, in the UK, in a lot of places. And the debate in some of these places are very heated whether we should adopt public net worth or not. In my mind, I mean, there's no discussion, and I will try to show why. An Australian finance minister once said when they introduced accrual accounting that using accrual accounting, because there was such a resistance, this is so difficult, nobody will understand it. Well, most of the population are actually involved in private businesses. A lot of small businesses, they use accrual accounting every day. So the people who are actually resisting this are mostly in the public sector and mostly economists. And what I would call normal people, because I come from the private sector, I've grown up in a private business, is that normal people understand accrual accounting, because that's how we think, all of us, every day. If you own a house or an apartment, you look at the market value to see if you can afford, in other words, borrow money to renovate the house, have a new roof, or whatever. The market value is your guiding principle. And you relate that to the debt that you have borrowed from the bank. And you can see, do we dare, let's say interest rates goes up or the market value goes down, are we still safe to borrow more money to change the roof or whatever you need to do? The public sector don't see it this way. The whole private sector looks at it this way, and every individual owning their own assets. Now, what does this mean? This means that private individuals owning an asset are always looking, this is human nature, to improve things. We want to make sure to repair the roof when the sun is shining, not when it's raining, because it's going to be more expensive and it's going to be probably difficult or even impossible. This is the human nature. Companies do this. When interest rates are low, when market values are up, when things are going well, we are looking for things to acquire, invest, improve in the production, etc. That's what you do. That's what human nature is about. Not in the public sector, because we are stuck with net debt over GDP or budget deficits, and that gives you the wrong sense of investing for the future. It doesn't help us to think, what are we leaving for the next generations? Just like with climate, what kind of world are we leaving for the next generations? Adrian was talking about this impassionately, and we have other people talking about sustainability. But what about sustainable finances? The best measure of sustainable finances is public net worth. New Zealand, with the help of Ian Ball, my colleague, did change this in the late 80s when they went through a financial crisis. So this is not rocket science. None of this is rocket science. You do this every day. You understand this completely well. The difficulty comes with explaining this to government officials, to especially economists, but also bureaucrats, who are not interested, you could say, in accounting or a commercial view or a financial view of the world. But New Zealand, so it's all about political will. It's not technically difficult, and it's not expensive, as most people will try to tell you. Moving towards accrual accounting is expensive, it's difficult. It's not. The benefit outweighs the cost and the trouble many, many times over. And New Zealand is the best and probably the only example of this. And they have a risk for natural disasters, which is even worse than Bangladesh, which means that they have suffered and they continue to suffer continuous earthquakes and floodings, etc., which hits their balance sheet. But they always bounce back. And they've had 2 financial crises and also COVID. And they came out of it faster and better than any other country in the world. Because what it does, it looks to the future. It makes sure that we are ready. We have a rainy day fund in case we have a natural disaster, in case we have a financial disaster. And it also looks to the future. What are we leaving to future generations? Are we leaving an empty a coffer, or are we leaving them strong to take care of problems in the future? Because we will have problems in the future. Now, the people resisting this will, of course, say it's very difficult and it's very costly. And we know from New Zealand and other examples, as actually Austria is a very good example, that it's not that expensive. And it's not that difficult. But with everything, it's about political will. And when I talk about this all over the world, people say, well, we've done it. And so, you know, we don't have to worry. And the thing here is that implementing accrual accounting is not just, it has to be integrated. Because what we saw, the first picture, which is my, you know, the two first pictures are actually my favorite pictures. The balance sheet needs to be integrated with the budget. If it's not integrated, it's completely meaningless. So one of my favorite countries is the UK in many ways, but it's also filled with a lot of irritation, because they always claim, well, we've done it. We've got the whole of government accounts, which takes 3 years to be published. And nobody has ever looked at it. It's just presented to foreigners as showing the UK is great at public financial management, which it is not, because nobody in the Treasury has ever read, sorry, but nobody has ever read it, and nobody takes it seriously, which means that they are not using the balance sheet to make decisions, appropriations. So the integration is absolutely critical. You have to think like a small business owner. When I grew up, my mother and father had each their small company, and they always discussed, in our breakfast discussions was never about who should take me to school or whatever that I had to handle myself. It was, how are we going to pay the different kind of bills? And what does the balance sheet look of that company or that company? I mean, and the company accounts was at the breakfast table, basically, which is the way it is for most small businesses. But it's a great lesson on, you know, where are the money, what do we do with them, how do we use assets in the best possible way in order to generate an income, or not to lose a value on an asset or a liability, etc. And of course, then we have the banks who always want their share. But it's the full integration. And I think the most beautiful example is, again, New Zealand, who, before an election, actually will not allow any party to have any promises, election promises, without showing, demonstrate in a 30-year, what do you call it, prognosis, forecast, thank you. 30-year forecast, what impact those election promises has on the public sector balance sheet, on public sector net worth. I think that's lovely. Because that's how we think. If we are going to mend the roof or fix the bathroom or whatever, we think, oh, what's going to happen with interest rates? Up or down, what's going to happen to market value? Can we still manage this despite a 2%, a 3% uptick on, or can we fix the interest rates so we don't have to worry for the next 5 years, etc.? We have to think 5 years ahead, 10 years ahead. And yes, I'll come to the next argument that I like, the counter. So, having a balance sheet, integrated, you know, the budget into the balance sheet, appropriations and everything, means that we suddenly see the assets and the liabilities, especially unfunded pension liabilities, which in many countries, many cities, not the least in the US, are many times the size of the debt, which we are focusing on to a completely unnecessary degree. But if we focus on asset management, which is my focus in life, the IMF, thanks to Sage's department, has come up with a number It's an approximation, but it's 3% of GDP that we can generate in income if we manage the 2 times GDP worth of assets in the balance sheet. I have added another 1 times GDP because the real estate, in my experience, having run around the world valuing real estate as a complementary fiscal space tool to 1 times GDP. So that's why I say it's 3 times GDP. So the 2 times comes from the IMF and the 1 time comes from my own experience. And this is by managing these more properly and by developing assets, especially real estate and SOEs, but also the infrastructure, we can actually generate fiscal space that is equivalent to 3% per annum. And then on the liability side, if we manage in those countries that have unfunded liabilities in a more professional way, say in a sovereign wealth fund instead of a public wealth fund on the asset side, it would be possible to borrow that money and generate another 1.5% as an approximation. This is not a global number. It's done on a couple of G7 countries only. When we look at how much unfunded pension liabilities there are, and so it's more of a teaser than an actually well-founded number. But it gives you an incentive to actually look at your country's unfunded pension liabilities and can we do this better? And you can, in most cases. Because having a shock and always having to take that from your taxes is not very clever. And this, of course, will increase not only fiscal space, but it will also encourage investment, which is important to have a more productive and more positive, I would say even for politicians, to show younger generations we are investing in you, not only in the graying of the economy, which is the case in many countries, not only in developed economies anymore, but also in China and many other countries. And of course, it will reduce fiscal risk, reduce corruption and waste, which are not unimportant. A big discussion is, of course, fair market value. Why? That's forbidden in most countries. Many countries have introduced IFRS, but as we know, IFRS does not tell you to use market value. It allows you to use whatever, and so many countries have a law that says you are not allowed to use this. And when you read the domestic debate and the what creates the work before the law, it's always an ideological issue that these assets are policy assets, they are never going to be sold. But as we all know, or at least having been a banker doing M&A half of my life, the saying in almost every country I've worked in Africa, Latin America, even in the US, Europe, Asia, and Middle East, the easiest way to get rich is to buy from the government because they're clueless and don't have the proper accounting. So without fair market value, we are not going to be able to have, to rectify this, which is, I think causes a lot of, undermines the credibility for the government. Because it creates a lot of, but then the question often arises, so what are you saying? Are you saying that the government shouldn't own any assets? Nope, that's not what I'm saying. I'm saying that there are 3 ways of improving the value. First of all, we have to agree that market value is important, even if this is not a business, this is not the private sector, etc. But it has to have, because the market value gives us the option. Are we going to make investments? Are we going to carry on maintenance? Without a price, there's nobody who's going to pay attention to these assets. And are we using them at best use? Do we even need them? All these questions will never arise without market value. But of course, when the question comes, should the government own or not? It's about the one argument is that the government, borrows so much cheaper, so they would be much better at owning these assets, which is very capital intensive. Fine, but then you also have to manage the other two ways of improving the value of an asset, which is operational and business development. And most governments fail at this as long as the asset is inside a government bureaucracy. And that's why one of the reasons why I argue for moving out SOEs, real estate, etc., into a holding company which we call public wealth fund. It could be a national wealth fund on the national side, or urban on the city or regional side, because that creates a shorter distance between decision making and who the decision affects, which is absolutely crucial, because the further away in decision making you are, the more corruption, the more waste you're going to create. And that's why when I restructure SOEs around the world, it doesn't matter if I'm in Pakistan, China, UK or whatever, it's the same. They're always incredibly, I can always promise to generate an income to the government within 6 months. One of the reasons is because they create conglomerates. They own so much more assets than the accounting has ever told them or they ever understand, because you never want, if you're running a government assets, you never want to give a dividend to the government because you know you're never going to get it back, because getting a capital injection from the government is impossible, because then you're fighting with childcare, hospitals, etc. So what you do, the instinct when you're running and owning a government assets is to falsify the accounts, if you like, screw up the accounting and to show a loss all the time. And that's one of the reasons. People running government assets are not incompetent. They're not fools. On the contrary, they're pretty clever. They just have a different motivation than you do. Their motivation is to show a loss so that they can get more money or never have to give a dividend to you in the government. And this is the mindset which is very difficult for many people in the central government to understand. If they can fix these two by putting the assets in a holding company with professional management, not outsourcing the management, but professional management, yes, then it's possible, and I prove it over and over again, that you can have the same yield on these assets as the private sector. Yeah, we've already talked about this. Liabilities are not. So the remedy is really to change the mindset, change the structure about this, and then to institutionalize this new thinking, or it's not really new, it's just very poorly understood. And I think the message, I don't know if, yeah, I think the final message is really for all of you sitting here, this is, once again, not rocket science. The difficulty is to generate the political will, and that requires being able to communicate this in a simple way and telling people why they need to do this. And that's one of the reasons, one of the best ways to communicate this is to have a number like this, 4%, 5%, whatever you come up with. If you can tell your government, we can generate 5% a year in fiscal space, we can reduce fiscal risk, which in many countries is substantial, that is something that they will understand. Unfortunately, most of the time when people ask me to help, I'm a bit like a doctor. Nobody comes to a doctor until it's too late. So they come to me when they have a heart attack or when they have broken the leg and say, can you fix this? Yes, I can fix this, but it would have been nicer if you didn't weigh 30 kilos too much, because then you wouldn't have broken injured your knee, or had a heart attack, or got diabetes, etc. So, the remedies and the prevention are very, very easy. It's not rocket science. You are sitting on them. But to make people stop smoking, lose weight, or whatever you want to call it, start exercising, that is the difficult issue. That is the challenge. Thank you.
Thank you very much. Thank you very much, Doug, for a very inspiring and interesting presentation and challenging us as an accountant as well. So just shaping it that this is a failure of accountants, and it's we are not helping to ignore, we are ignoring reality, which is a big mistake. And with impact decision making, we need a market value, and also another message that we don't need just to privatize, get rid of the assets, but we need to more effectively manage that. I expect many questions in the audience. Who would like to go first? As people are just probably, as Adrian, please. Yes, Mike, please, in front of you. Yeah.
Thank you. Very interesting. Very interesting and very compelling. But we just had the presentation about consolidation and all the problems thereof. And this is adding on another level of complexity and challenge. So, simple question, where do you start?
You start, I think, okay, the technical question is you start with an asset map. I call that an asset map, which is an indicative valuation, which is really a rough, back of the envelope assessment of what do you actually own. And I wouldn't start with the, the infrastructure assets, if we can, that's huge, but I would separate the two. So the easiest way to get the attention of the people, the policymakers, the decision makers in a country or in a city is to look at what I call public commercial assets, which is the real estate and the operational assets, which at the national level is called state-owned enterprises. I really, really, really don't like that word. And I hope we can get rid of it in accounting and call them operational assets or whatever, because the value is not at the national level, it's at the local level, and we miss them by only focusing on SOEs, which are very fancy, cool, and everything, and they're fun because everybody sees them. But from a financial perspective, you know, there's so many more assets, and not the least real estate. And making an assessment of those, the operational assets, and the real estate assets mustn't take more than, let's say, 3 months. Even in a country where you don't have the land registry, the cadastre, and all that. You just have to make an assessment, because what you want is that number. You want a number. The same reason why I am trumpeting out to you 5%. I want you to go home and tell your finance minister and tell your neighbor, we can generate 5% of GDP every year by managing our assets better and having better accounting. I want you to, I will always get a lot of criticism for that, because there are many people much more clever than me who can contest that number. But it's not, I'm happy for it, because if you start contesting it, if your opponent starts to contest, that's great. Then you have to have a debate. The most horrible thing you can have is not to have a discussion at all. So by doing this in 3 months, if you do it longer than 3 months, so I started this 20 years ago in the UK. They're still not finished, because they are doing it in a way, and they are letting in, you know, real estate professionals. They are counting every light bulb in every house. It's absolute madness. That's not the point. The point is to have a number so that you can say, we have assets worth X. And by managing them better, let's take the IMF, 3%. You know, you start a discussion, they start thinking, my God, 3% of that, you know, that's, or 1.5% of that asset value. I mean, that's amazing. You start a discussion, that's 1.5% times that asset volume every year. That's money. This is what we are debating. I mean, the whole, so do not allow them to make any, I would say, don't let accountants in on this, because they will be too meticulous. The accountants come in later. So the important thing is to do it on an Excel spreadsheet no longer than 3 months, because after 3 months, my experience is the political resistance will be so, stakeholders and people who are benefiting from this will crush you. Everybody who is using this for corrupt, and I can tell you, I've had Kalashnikovs, I have had everything, Uzis in my head, trying to, you know, do these things. And in various countries, but you know, so you have to be quick, and ideally so that nobody understands you're doing this. But you just want that number to highlight it. That is to get the political momentum, but that it also gives you an idea. Okay, what do we do with this? Now we have a rough. Now we can at least touch and feel the portfolio. Now, how do we do? How do we structure it? What do we do with it? What's going to be politically? And you let people with financial, call it financial background to do this with a strategic background, and then throw it at the politicians, who then will say, well, that's going to create a chaos, that's going to, you know, get me shot, if not you, etc., etc. So then you sort out, that's stupid to include, let's take that out, etc. And then you see what you got left, and if that is good enough to create some fiscal impact. But you have to move fast, and you have to move, you know, all this detailed stuff for accounting comes in when you have consolidated in a holding company. That's when the accountants come in and do their real work. Yes?
Uram, yeah.
Thank you very much. Fascinating and extremely compelling, as always. This is my second that I have attended. Last time also I was there. So I think I am repeating Adrian's question from a people dimension, because the answer you gave is more the technical side. Do the numbers and create an argument with the politicians. But there is a second dimension, which is the people dimension. In most of our client countries, there are armies controlling these assets, there are dictatorships, and then there are very corrupt politicians and coalition partners in the government. How do you overcome this conversation? Because they are beneficiaries of these huge billions or maybe trillions of dollars
absolutely.
Assets. So asking an army to transfer their assets
you can't.
to a holding company.
Well, you have.
Very powerful ministries to transfer a Ministry of Defense or whatever. So how do you have the people management side of the conversation, you know?
Yeah.
Have you some experience of
Absolutely, absolutely. So, I mean, I can come to a country and they say, their first argument is, this is all very nice. I understand it because I worked in finance, blah, 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 and I totally agree with you, but we don't have the capacity in this country. So that's argument number one. And then I often point to, well, you do, because you have already 3 holding companies. Pakistan, owned by the military. Egypt, 3 holding companies owned by the military. Myanmar, 2 holding companies, or maybe 3, owned by the military. So the capacity is there, and what you do, I think it's more important if the Prime Minister I worked with was a political thug or mastermind, and we did a lot of, or he did a lot of fighting to consolidate these things. But some things he couldn't consolidate. He said, that's going to cost me my career if I do that. So what we did, so we managed to consolidate all the SOEs into one holding company, but we didn't manage to consolidate the real estate, which was probably worth 4 times as much. So what we did, we had each ministry having their own holding company. So, I mean, in my book, not my book as in written book, but in my mind, it's much better that the military creates a holding company. Because, and what we then, because then you take the next step with the next head of the arm or head of the armed forces. I want you to produce proper accounts, etc., etc. And you create a political pressure on them, because having the visibility, they are there, they have a, it's much much easier for me to have a fight with somebody who has an account, who has a holding company, who has a grouping, and who are actually acting. When it's diffused, nobody sees it. And that is the worst enemy I can have in a country. So I'd rather have the Ministry of Defense creating, I've tried for probably 15 years for the Ministry of Defense in the US. They have trillions of dollars worth of real estate. And it's just not happening. And one of the reasons is I have been wrong. I've been talking to the Minister of Defense. People tell me if I instead talked to each armed forces, it would have worked. I didn't understand that. Same thing in the UK. So the Minister of Defense is not they don't like each other. The Navy doesn't like the Air Force doesn't like the Marines, etc., etc. So if I ever get the question again to do this with an armed forces in a country as big as US or UK or anything like that, it's much more clever to consider the political forces and who is a team, but never try to take it away from them, because that's just not going to happen. Only if there's a crisis, you can do this. If there's a real crisis, then you have the opportunity. So we did this in Sweden. When we had the crisis, we were going bankrupt, so the Prime Minister basically said, he asked me if I wanted the job, and I said yes, but we need to consolidate. So when he formed the government, one, there was a crisis, and two, he had the opportunity to form the government, just to tell you a little bit of a trick. But he appointed every minister with a condition. I'm asking you, you have 30 seconds to accept the appointment, and it's going to be without any assets. Do you accept or not? 30 seconds. And in that situation, the politician was more keen to become a minister than to argue about the assets. But once he is a minister, it will become a cabinet problem, and it will blow up in the papers if you try to take away the assets.
Thank you. It looks like most of the questions are coming from the back to the front to you. Great presentation. Thank you very much. I would like to focus my question on the other side, because your presentation focused on developed countries. And we do not have information on the developing country or countries under development. My question is that in most of the developing countries, government has literally no assets, because in the past, advisors from different organizations say that the government doesn't have the capacity to run a public asset or operational asset. Therefore, they need to sell those assets or privatize them. And your previous speaker also spoke about the equity part that the government have on those assets remaining and so forth. From the accounting point of view, what is the asset list that you refer to? Will it be part based on the equity part, or will it be part of the entire asset that almost scattered around with private and government small shares?
No,
what are we referring to?
I mean, first of all, I don't...
A sub-question, sorry, let me finish my thought. A sub-question is that where this asset is in the government, especially in the developing countries, the IPSAS is also finding very difficult how to quantify those assets, like, for example, the museum, the park, the natural resources, and so forth. How are you going to produce that Excel sheet that you are referring to? Thank you.
Okay, first of all, I haven't been in all countries of the world, but I've been in quite a few, and I work in Nigeria and Ethiopia now. We've been quite successful in setting up holding companies, in doing the asset map, etc. So my experience with, and all over Asia, it's the same in developing countries there, it's rather the opposite. It's the developed countries that have privatized most of their, well, actually, the IMF study that just came out doesn't really agree with this, so I'm not correct here. But I mean, as an amount to GDP, I would say developing countries have probably a greater amount of public assets than developed economies. Absolutely. Partly because if we just focus on the public commercial assets, which is the real estate and the operational assets, that is usually 1 times GDP. The real estate is 1 times GDP in developed economies, and that is equivalent to half of the real estate market. So the public sector actually controls half of the real estate market in places like the US, UK, France, Germany, etc. However, in many developing economies, I mean, they own 100%, not half. So the share of public assets in developing economies is absolutely vast. But you are mostly forgetting the real assets. So you're talking about the financial assets, which sometimes is recorded in because you have a market value already, they're traded, or somehow there is a market value on. I mean, they are minuscule in my view. What you're missing are the non-traded, non-financial assets. And in many developing countries, they are not even incorporated. There are huge companies of many sorts. Many developing countries, Ukraine included, the corporation that you see has no assets at all. They're owned by the ministry. I mean, it's complete madness. You can't, I mean, the accounts are completely meaningless. And I mean, the biggest company in Ukraine, Naftogaz, doesn't even, or up until recently at least, didn't own their assets. It was owned by the Minister of Energy. And it's the same with many of the SOEs in Ukraine and many other former Soviet governments, Soviet countries. So I would absolutely think it's fair to say that developing economies have an even larger potential to find and manage their public assets, especially real estate, but also operational assets. Not the least at the regional level. I mean, utilities, transport, etc., ports. I mean, they're enormous assets. But you just have to, I think the difficulty is, one, to see them as assets and commercial, and that they have a potential to be developed and generate an income, rather than being a cost. This is the shift in the mindset, in my view.
Thank you, Doug. Just one reflection, if that is, because whatever you tell, it's so easy to understand, at least for our group. The question is, if it is so easy, why it is not done in the countries? And
that's the billion-dollar question. It's political will, and it's because we, as a community, I think, have failed to communicate this to the people. What we show in the book, thanks to Jacob Saul, is that we have at least 500 years of history with governments in different countries that have actually tried to introduce a balance sheet. And where they have succeeded has either been for a political will of a certain leader, like Colbert in France, and we have Harrison in the UK, and we have one guy in Holland, etc. But as soon as these person, I mean, there's two lessons I think we can take from this book and from this history. Is one, when these, with these dynamos dies or gets thrown out, the whole project dies. And why is that? It's because there is no understanding among the people. There's only one country who really had a financial literacy, you could call it. That's Holland, because Holland is created out of nothing. It's called the polder system. Where there was water, they actually created dikes and dams, and which created new land according to a system called polder, and this they owned in a common way, and they started to create common shareholding, etc. And sooner or later they created the first stock exchange thanks to accounting. So accounting was something that everybody, every farmer understood the essence of accounting. So introducing in the public sector concepts of balance sheet, equity ownership, etc. in a place like Holland was easier. And so it's no coincidence that the first stock exchange and the first listed company was created in Holland, and then later this whole knowledge was transferred to the UK. It's because of the financial literacy, and so. But the hope that we all can have is what the Australian finance minister said, that most people in market economy who are, that have some kind of relationship to a small business or owning something, they can relate to this. So the trick is to make them see that this is similar to what you're doing with your house that you own, or with a business that you own or work in. I think this is the connection. If we can help doing that, and if we can help our politicians and bureaucrats making that connection, which is a small contribution with this book, I hope, then I think we have a chance.
Ian, please.
I think what you said in terms of the whole, how do you make culture change happen, is excellent. And the question in my mind, though, is because I think I can relate to the point you're making about the fact that if you lose the champion, then the reform is likely to die. And also, I would say politicians are very much in favour of this when they're in opposition, and when they've been in power for a while and things don't quite go the way that they want, then naturally they become less enthusiastic. I do think that the international institutions actually can really help in terms of creating and sustaining an appetite for reform in jurisdictions, and perhaps controversially sitting here in a World Bank event. I just wonder, what thoughts have you got in terms of, if you like, the additional power and incentive? Perhaps what should World Bank, IMF, the regional banks actually do to help create the right climate?
Oh, I love that question. I hope you don't, Adrian and Saga. I hope you don't mind, but my Christmas wish list is, I know you're going to fall back, but Article 4, I mean, I'm a complete outsider, but I think, the debt sustainability analysis could help by incorporating assets as a measurement as well, and liabilities, and not just debt. I think that would help. The IMF actually have, in the GFSM 2014, there is accrual accounting as the preferred way of managing public finances accounts. But again, it's not really taken into the debt sustainability analysis, DSA, it's not taken into the Article 4. And I think if the World Bank and the IMF could consider this, I think it would be incredible. I think it would be not the least for developing countries. But absolutely, I think I'm an optimist, and I try to find opportunities with everything. But the future is not orange. The future is quite gloomy. So I think we need to be prepared. And even the G7 countries, even the developed economies, need to consider, because they have done a lousy job managing their economies and their finances. And if we're going to be, and I think the G7, or the rich countries of this world, have a huge responsibility, not only to manage their economies, but also to help other economies in the world, because we're not going to get through this without being helping each other. And not the least, we have a lot of problems with a graying economy, graying population, and we have huge problems, and geopolitics included. But we have this climate mitigation, climate adaptation, which is going to cost a fortune. And if for the world, but also we need to help. The G7s, the rich countries of the world, needs to be really good at what they're doing in order to be able to help the less developed economies. Otherwise, this is not going to work. And there are many more clever people than I who are talking about this. But I think that is the responsibility. That is, so it goes all through any economy, that we need to be better at this, because the numbers for, again, just to make it clear, the numbers that you see from many of the institutions trying to understand what will climate adaptation and mitigation cost. It's about 5% of GDP over the next many, many, many years. Where are we going to get that from? Raising taxes? What politician is going to raise taxes? What politician is going to do another level of service cuts? Those politicians don't exist. We need to find it from somewhere else. And this is one source. If we think that we can generate 4 to 5% from better accounting and better management of our balance sheet.
Excellent. And one is last question, and we'll break for lunch.
Да. Спасибо за очень.
Thank you for a very interesting presentation and for very interesting ideas. I have a question and a comment. We understand that we are here experts in accounting, and this is very useful information when the information is used based on the accrual method and is presented at fair value. Why the government is not embracing this approach? Why it is not spending the money? When you raise this question, what is the answer from the government? It's not time yet. This is time-consuming, finance-consuming work, and let's put this off until the future. We have to take into account the accrual method. This has been the talk for the last 15 years at fair value. But they don't arrive at fair value. If we go deep, they don't even know the assets that they have. There are some assets that are not even taken into account. Everything is fine. They are writing good reports, providing good reports, and everything seems fine. My question is, how do we get them interested? How do we get the states interested so that they get involved? Because without the accrual method, based on the historic value, this information is not useful to arrive at effective solutions. How do we get them interested? How do we get them enrolled, to get enrolled into this work?
For the lunches actually reflects on the same points as you raised, that accrual and fair value or market value is accepted by the governments. Many say yes, it's needed, but on implementation they are dragging because they said it's too complex and costly to implement. Even in many countries, governments are not aware of their assets, the assets they really own. Just even the listing of assets is not completely available. So the question is again back to the political will. Again, how to force governments, because in this room everybody understands the need and this is needed. So how we can force our governments to make the change?
Yeah, you have to have a you have to have an opening. As I said, I'm a doctor, so nobody is interested talking to me until it's almost too late. But sometimes I do get invited before it's too late. You have to have somebody who says, you know, please come here, please talk to me, you know, do you have any ideas, blah, blah, blah. You have to have some kind of champion. If you have, I come from the private sector, and the people I work with in the Swedish government thought I was hopeless because I didn't follow the rules. And they were always joking because I used to play hockey. And I presented to the Prime Minister and the President, and they said, you're like a hockey player. You still keep playing ice hockey. You shoot once, never to aim to score a goal. Because what you go for is the return. And you go for return 5 times. You're not supposed to do that. If the Prime Minister says no, it's no. You must accept a no. But if I accept a no, you know, we're not going to get anywhere. So, you know, when you have somebody who is prepared to listen, the trick is always to present that person with this number, you know, and repeat it over and over again and never give up. But you have to have the number. If you can't do the asset map in 3 months because you don't have the resources, I usually, sorry to say, I fake it and I say, based on this experience, in 20 other countries, we could say the real estate is worth at least 1 times GDP. In Pakistan, I would say it's 1.5 times, 2 times GDP, whatever. And then you put a real number in that local currency just to show, and then you translate it in with 3% and say, this is what we can generate if we manage it better. You have to show the number. If you start talking to people by saying, we should introduce accrual accounting, they fall asleep. It's the worst opening remark on a date. You don't start a date by asking, what's your shoe size or whatever, or I think you should change hair color. That's not a cool way to start a conversation at a date. Nobody's interested to listen. You have to start with something that is sexy. It's the number. So just take that 3%, 1 times GDP, said, this is what I can do if you let me. And what do you need? Okay, I need 3 months. I need 3 people to do an asset map very quickly. Nobody's going to notice. You have to make it feel that, don't worry, we're not going to jeopardize your political career. We're going to make it, we're going to give you an opportunity. You always have to tell politicians about opportunity, not about the problems. And they're going to say, well, I don't want to show how much assets I have, because then I can't raise taxes, or then they're going to demand much more services. That I think is a problem. But that's why you need the financial crisis, because when there is a financial crisis, they are more keen on having the money. If times are good, they are not interested in having that excess money, because that's dangerous.
Thank you, Doug. And I will probably, that's the last point, I will just read from your article in Financial Times, yesterday's article. Okay. Your book is that it's better roughly to be right than to be precisely wrong. So we do not need, we should avoid ignoring reality, which is a big mistake. So that is a very enlightening discussion and presentation. Thank you very much for the session. So now we're breaking for lunch, and we will be back at 2 o'clock. Thank you.
Hello. Good afternoon again. Happy to see all of you again here. I hope you had a great lunch and a good possibility for networking. During the morning, we had a very interesting session on consolidation, and this is the follow-up session that will focus on country experiences and lessons learned. The session will discuss the concept of consolidation of financial statements prepared under different reporting frameworks, including local governments, state-owned enterprises, from the perspective of the best practices and country experiences. We have a distinguished panel with us: Andreas Bergman, as you all know, Professor of Public Finance and Director of Public Sector at the Zurich University of Applied Sciences; Giuseppe Grossi, top scholar, research professor of accounting of Nord University, Norway, professor in public management and accounting of Kristianstad University in Sweden. We have a colleague that is presenting remotely, Manji Kalar, who is an IPSAS expert. And we will close with Thomas Müller Marquez Berger, partner and global leader, International Public Sector Accounting, Ernst & Young, EY, chair, IPSAS Board Consultative Advisory Group. So we will start with Andreas Bergman. Andreas, the floor is yours.
Thank you very much, and thank you very much, and good to be back. Actually, in my presentation, I will build on the presentation Durlandi Cubillos and myself held 1 year ago here in Vienna. So first of all, we do a small exam on that last presentation. Well, of course not. No exam, don't worry. No, but we will actually build on the presentation we gave 1 year ago, because what we did 1 year ago is introduce you to a generic and comprehensive consolidation and GFS compiling process. And that's actually where I start from this time. Now, what I do this time is I will have a look at how to integrate with budgeting, because obviously that's one of your concerns, how to integrate with budgeting, also how to integrate with local governments. I think that's the idea, sort of to build on what I presented or what we presented, the two of us, a year ago, and integrate budgeting and local governments. We will do so also including international examples and then come to a conclusion. Now, this is the generic and comprehensive consolidation and compiling process. We showed you last year, and actually, well, the good news is, if you don't remember it, no worries, because the World Bank has since, in February, published that technical note. So you have this in a technical note provided by the World Bank, by the PULSAR team, and this is basically just a repetition, as I said. However, I think I want to remind you of some important steps. Certainly, the first step is very important, that you're very clear which are the entities to be included, and which entities are part of the general government sector, which entities are part of the public sector, which entities are controlled. To have a clarity about each entity. So if we look at one entity, to say, yes, this is part of the general government sector and it's also controlled, or it's not controlled, but to have a clarity on the entities. And the second step on this first slide is actually also very important, the chart of accounts. Certainly we heard this morning, this is the key also for integration then with GFS. So we need to have a uniform chart of accounts, or at least some bridges between the charts of accounts, in order to make sure that we can consolidate and can compile the data. I fast forward to the second part of the process. Yeah, it was not all. It was actually 14 steps also last year. Because then basically the idea is to firstly do the consolidation according to the accounting standards, to IFMIS 35, of the controlled entities. So, well, that's why you need to know which entities are controlled, obviously, because if you don't know which are the entities that are controlled, you will not be able to consolidate them. And then in the second part, after step 11, compile the statistical sectors, certainly the general government sector, but eventually also the public sector, and prepare the statistical reports. So basically, it's sort of 3 steps. If I go back, it's some sort of preparation work you need to do, then prepare the consolidated financial statements of the controlled entities according to IFMIS 35, and then prepare the statistical reports based on the GFSM or ESA. So now, I mean, how does this work with budgeting? Because obviously budgets are the most relevant part of fiscal policy. And I think this goes also along with what we discussed with Doug in the morning. You need to convince the politicians, and certainly it helps if you have budgets included in your financial reports, because then they become more relevant for the politicians as a document. So how can we do that? Well, I mean, as you can see here, this is also a slide we already presented a year ago. I mean, you have that sector delimitation, that's basically all in black. You can see it's the central government sector, it's the state government sector, local government sector. They make up the general government sector, and then we have the public corporation sector, including the financial corporations and the non-financial corporations. So that's a sectorization. On the right-hand side, you have those entities outside the territory in other countries. So basically what we told you is that, well, the red line is showing the entities consolidated. So it's a subset of entities from different sectors. That's the important message. Don't count them, please. Don't say, well, it's only one entity from the non-financial sector. Well, that's just a graph here. It will be many more than one, obviously, but we just want to show it's a subset of entities from different sectors. And so is budgeting, and that's actually the new thing. The blue line is new. That one was not presented last year because yeah, what is budgeting? I mean, budgeting is also a subset of entities. Usually it does not include the corporate entities, so that's why it doesn't go to the lower level of that slide. And usually it only includes actually part of the central government entities, because sometimes many governments have some extra budgetary entities. So often they are called funds. They have extra budgetary funds, for instance, and then they are not part of budgeting, as the name says. So actually, it's yet another delimitation you find inside that field of entities. And so how do you integrate those? Well, of course, I mean, usually you have to consolidate as well, because it's more than one entity. So that's already a consolidation. It's not the consolidation according to IFMIS, nor the one according to GFS, but it's a consolidation of several entities. That's why I have the 4 blue dots on the first point. Usually, they do respect the sectorial boundaries. So quite often, actually, all the budgetary entities are part of the central government. There are exceptions in a very few countries where the budget also includes, for instance, some subnational governments. That can happen, but in most countries it's actually limited to the central government, but not the full central government. Because, that's the third point, usually some entities are extra budgetary entities, they have to be excluded. So that's why you have a white dot in the third line item. And then, of course, they sometimes also even include some entities which belong to another sector. That's what I mentioned. Maybe they include some subnational governments in the case of unitarian governments. Or in some countries, they may even include some of the state-owned enterprises, usually not all of them, but some of them. And well, in the end, where do you have to look up which entities are included? Well, that's the law, and usually the law says that budgetary entities lack legal personality, so usually they don't have their own legal personality, they're part of the government, of the state, of the nation, whatever you call them, to define that. So basically what I'm telling you, well, it's just another categorization you need to do. We learned last year you need to know which are the entities that belong to the general government sector, to the public sector, which are the entities that are controlled. So if you want to include budget, you need to also know which are the entities that are included in the budget. That's sort of another additional possible delimitation. Now, I was asked to give a few international examples, and it's actually 2 of the examples we already used last year, because they exactly do that. The first one is Spain. Spain has basically 3 reports. You can see that the cover sheets of the 3 reports here. And I start from the left to the right. And actually, the one report which is very important in Spain is the budget execution. Well, that includes, that's no surprise, the budgetary entities, which are not all. It's as I said, it's the blue ones on the previous slide, so it's only a part. It's actually the smallest group, and then when we move towards the right, the entity becomes bigger and bigger. But yes, it is, of course, very important to have a comparison with the binding budget. Why is it binding? Well, because the Congress, the Parliament in Spain has approved it, made it binding. So they have to show, yes, we do comply with the budget. And that's why they produced this report. They produce also consolidated financial statements, which include the state-owned enterprises. But of course, I mean, they are not included in the binding budget. So what they do is they have an estimational budget, as they call it, for comparison purposes at the consolidated level in compliance with IFMIS 35. Now you can see both the budget execution and the consolidated financial report are including the national level only. Why? Well, Spain is a decentralized state, and it becomes more decentralized these days because the separatists are joining the government now, and so definitely they cannot pretend to have control of the regions and of the municipalities, so they do not consolidate them. But how do they include them? How do they get the pictures Sahe mentioned in her presentation in the morning? How can they monitor basically the behavior of the subnational governments? Well, they do that based on the system of national accounts and based on GFS, and that's the report on the right-hand side. So this report is obviously including the entire general government sector. As you can see, it includes all the subnational governments as well. But it does not include a budget comparison. I think this is what we realize in Spain. Why not? Well, because actually each of the local governments and each of the regional governments has their own budget, which are not approved by the central government. They are approved locally or regionally. So that's Spain. The other country is, well, if you permit me, Switzerland. We are a federal state, but we have a very similar situation like Spain. From the left to the right, again, well, the first one is a budget execution report, which is already a consolidation, but it's a consolidation at the level of the binding budget. So I was actually quite happy to be lazy, because really the text on the left-hand side is exactly the same like in Spain. And that's not because I was lazy, that's because it is the same kind of report we have in Switzerland as they do in Spain. Then in the middle we have the consolidated financial statements, including state-owned enterprises based on IFMIS 35. And so far it's also the same like in Spain. The only difference is actually we don't do a budget comparison. So there I could not copy-paste the slide from Spain. I had to add something different, and that's why it's in italic. We don't do budget comparison. Why not? Well, we don't have those budget estimations. We only have the binding budget, and that does not include the state-owned enterprises, so we cannot have a budget comparison. And then on the right-hand side, you can see, well, again, the same situation. If we want to have the picture including the local governments, we need to have a look at government finance statistics, because we do not control local governments or state governments, and we only have them included in the statistical report. But we do have them included in the statistical report, so we can monitor the information Sahe from the International Monetary Fund urged us to have. In conclusion, a consolidation process is usually necessary for all three reports, not just for two. It's necessary for a budget execution report, including all budgetary entities. Second, it's necessary for the consolidated financial statements according to IFMIS 35. And thirdly, it is necessary for the compilation of government finance statistics in compliance with the European System of Accounts, or GFSM, from the International Monetary Fund. And all three have their own purpose and have their own users. So it's not that they are redundant. It's not that we produce too many different reports. Each of the reports has a very specific purpose and is needed. That's my short presentation. Thank you so much for your attention.
So thank you for the introduction. Very happy to see you after 1 year. I don't see yet my... Okay. So last year, I was very happy to come here in December, and I concluded with one slide comparing Slovakia, UK, and also Estonian case. Today, I was almost sure that John Verinder and also Janka Reuters, they refer to the UK case. So I decided to select the smallest case, Estonia. So that's why I refer in my introduction to the Bible and the giant Goliath was defeated by David. That's the story of my short presentation. Let me say why Estonia. Estonia, surprisingly, was included in the Eurostat report 2018, and Estonia is the only case in Europe with Slovakia and also UK that they have all of government accounting. So that's why the reason. Second reason, Estonia is the first country in Europe to introduce IPSAS already in 2003. So that's why they have very mature consolidated financial statement. So when I was invited by PULSAR team, thank you for the new invitation, I decided to have in my short presentation, 10 minutes, a brief overview of the Estonian case because it can be very useful also for other PULSAR countries to follow such examples. Let me say something about my starting point. Last year, I concluded with this slide, and this slide is coming from Eurostat report 2018, and we see that Estonia was officially recognized as a mature experience on consolidation, and all three cases, they are consolidating at state level, local level, and they have also WGA. They are following IPSAS in the consolidation, IPSAS that we have already seen this morning with the very nice presentation of Janka Reuters, but they are also using IPSAS 22 for general government statistics and public corporation, and we see that they are already using for different purposes consolidation, especially for long-term fiscal decision. I would like to go inside the experience and tell you something about the Estonian trajectory. What can we learn by the Estonian case? They started at the beginning of 90s. You know that Estonia was part of Soviet Union, and in 1990 they started to introduce private sector accounting standard, but still in public sector in the first phase they were using cash. In the second period, in 95, they started to mix cash and accrual. But the real radical change in Estonia started, as I told you before, in 2003. So they have almost 20 years of experience of IPSAS adoption. And this IPSAS adoption was very useful for consolidated financial statement, as we will see in a few seconds. And I really like Andreas Bergman's presentation because they are trying to work on the connection with budget in general and these three experiences. And I think that one successful outcomes of the Estonian adoption of IPSAS is related to the ability to adopt accrual-based budgeting, and they started in 2015. I was very lucky to work with the Estonian government and assist them in this transition from cash to accrual. We made a lot of training in the Ministry of Finance, and we decided to write a report with Peter Ped. At that time, he was working in the Ministry of Finance, and we were focusing on institutional entrepreneurs. Who are the institutional entrepreneurs? I think that institutional entrepreneurs are the financial management community. This is the PULSAR community. You can be institutional entrepreneur and introduce changes in your country. And in our story, the institutional entrepreneurs were the chief accounting officer, and they also created a shared service, accounting services, an agency that were supporting all entities included in the consolidation, and also the Estonian Accounting Standard Board. So we can call them collective entrepreneur. It was not just a single person, it was a team of people that they were able to introduce changes during the last 20, 25 years. We know from Estonia experience that we have two levels of consolidation. Let me say something about local government. There are 69 local government, 35 rural government, and 15 urban governments. So let me say Estonia is a small country, 1.3 million of inhabitants in total, but they started to consolidate at the local level. They moved to the state consolidation using the concept of control of IPSAS, and they included in the consolidation national, local agencies, non-profit organization, and in general, control and associate entities. But they have also consolidated financial statement of general government service, and they, statistics, sorry, and they introduce all state and local government consolidation, but they didn't include market producers. So in connection to the presentation of this morning, the book introduction, state infrastructure company, they were not included, but in the GGS, they included social insurance funds, public institution, public university, national library, opera, national broadcaster, and several national defense organizations. What is it interesting that in GGS, they included 95% of total national expenditure. So the GGF is really representative of the overall total expenditure. And the last document is the whole of government accounting. And this is important because all of government accounting includes 1,000 entities from local, regional, and national level. So here we have in WGA examples. We have examples how these entities, they are included. And we have also, let me say, they are not using IPSAS 18 on segmented reporting, but as I told you, they are using IPSAS 22. And there are no exclusion also for smaller or less risky entities. And WGA is produced annually by the Ministry of Finance, but thanks to the software, they are also able to produce a GGS on a monthly basis and a public sector consolidated financial statement on quarterly basis. But they are also using consolidated financial statement, especially the WGA, for a long-term fiscal decision. And this is my conclusion about the benefits. Why countries like PULSAR, they should follow this interesting national experience. Today I was talking about Estonia, but I know that Slovakia made a similar trajectory. So we have long-term fiscal decision. We have, of course, an improved transparency. And we have wider management reform. And let me say that Estonia, when applied to become member of OECD countries, they asked clearly to Estonia to implement IPSAS and to adopt performance-based budgeting. And if you go on the Ministry of Finance website, you can find the overall packages. And this morning, Janke Ruterts was referring to these overall accounting packages that starting from budget, accrual budget, performance-based budget, consolidated financial statement, WGA, and so on. Another important advantage is related to Eurostat calculation. We know that Estonia is now a member of the EU, and they are also a very credible countries because they introduce several reforms and they are very advanced in e-government. And I know that e-government and digital government, they are important topics today, tomorrow, and the day after tomorrow. My suggestion is to have a look to the state accountancy website. You can find the last edition of the consolidated annual report of the state 2021 in English. You know, Estonian is a quite difficult language, but on the website you can find in English the overall packages, accrual budgeting, performance-based budgeting, and all set of consolidated financial statement. So thank you for your attention, and I hope that the Estonia experience will be inspiring also for some PULSAR country that will adopt consolidated financial statement and WGA. Thank you for today.
Thanks so much, Giuseppe. Very interesting. Do we have Mani Kalar connected, right?
Yes, I'm here. Can you hear me?
Hi, Mani. Nice to
Hi,
see
how are
you.
you?
Perfect. We see you, I hear you perfectly, and I understand that we're going to project the presentation from here, right?
Oh, okay. I have my presentation here for you, so I don't mind. I'm in your hands.
You can start with the presentation, no worries. If it doesn't work, we transfer you from here.
Perfect. Can you see my presentation?
Yes, perfectly fine.
Perfect. Excellent. First and foremost, my deepest apologies. I couldn't be there in person. Yes, I can't tell you how disappointed I am. British Airways very kindly decided to cancel my flight. I was one of the few that, so I have Debbie to moan at. We had a storm here, and unfortunately my flight into London was cancelled, etc. So I'm joining you virtually, so I hope you all are having a good time there. So I've been asked to talk about consolidation of public financial statements. I thought I'd share my experience leading the whole of government accounts for UK government. So a subset of even of UK government. Ian's already covered some of them. But I do want to take a little bit of time to take a step back and reflect back to you as PULSAR members and everybody who's there, that it's a mark of your achievement, the fact that in your journey to implementing accrual accounting, that you're looking at all of the issues, the wider issues in terms of consolidation, in terms of how best to achieve that, rather than moving on from where to start from. So I do hope that you do take some time out to reflect and acknowledge your achievements. I don't mean that in any... Sometimes we have to celebrate the small successes along the way. Anyway, so why consolidate? The case has been made very well by others. It's well rehearsed. We want greater transparency. We want increased accountability. We also want better information for decision making. Okay, but to follow on from Dag's really interesting presentation this morning, I too will be a little bit provocative and suggest not every nation, not every government wants enhanced transparency and accountability. But the question is, we should want it, because it should enhance assets and liability, asset management, highlight our liabilities, highlight the hidden liabilities in terms of our contingent liabilities, the risks and therefore make an assessment about long-term fiscal sustainability of our public finances. Can we afford to carry on as we are? And as the good doctor said this morning, prevention is better than cure. I would argue prevention is cheaper than cure as well. And as accountants and finance professionals, I think we all would be happy with that. But the question is how? What are the practical challenges and how can these be overcome? So I'll share with you what I did in local government, and hopefully there will be some lessons in there. And my glass is half full too, so hopefully I'll offer you some solutions as well as to what I did, and please copy them, use them, adapt them for your local context if they work. So who am I? Some of you, I'm conscious, will know me, others may not. So 30 years ago tomorrow, I joined UK central government straight from university, I started off as a VAT inspector, as a tax inspector, how to make myself popular. But I quickly moved on to preparing the financial statements on an accrual basis. We were on this project looking at the expenditure side, then government income, i.e. taxes. Then at the Home Office, our UK Ministry for Policing and National Security. Then at DCLG, which is the Department for Communities and Local Government, where I worked closely with Treasury on the whole of government accounts consolidation. Then I worked at CFRR for 5 years, looking at central government and financial management, and latterly at ACCA, where I was Global Head of Public Sector. Since 2017, I've been a consultant, so advising and IFMIS training, accrual accounting implementation, etc. And I'm doing a project at the moment with CFRR, working on implementing accrual accounting for tax income in Botswana. That's a little bit about me, but you want to know more about consolidation. So we talked about some of this already. First question to consider, boundary. Which entities are to be consolidated? So do you follow the national accounts definition? You've been pairing that, or the accounting definition. Clearly, there is value in both. And obviously, as Andreas has just said, they're used for different information. But if we can somehow align the two, and that's difficult, obviously, because of the consolidation definition in terms of control, how do we align them so that we can provide the sector-specific global picture in the statistical reports, but then you get the ability, the unique ability that the financial statements give you, the ability to drill down into individual entity accounts to identify, to go back to identify if you've got an issue, and you can drill down into the detail. So, like I said, clearly there's value. I mean, huge steps have been made to align the public sector financial reporting standards and the private sector. Ian's already covered this morning in terms of the alignment of IFRS and IFSAS as far as possible. So, for the boundary issue, you mentioned this morning, we talked about the issue with statistics and with the national within the national accounts definition, and the accounting definition was an organisation called Network Rail, where the rail infrastructure within the UK was not included because statistically it was determined it was not in the ONS, the National Office for National Statistics, decided it wasn't to be included. But under central government, under the accounting definitions, central government indemnified the debts. We said that we would cover all of the debts. Therefore, that pretty much hits the definition of control. So it should have been in. So it was one of the few qualifications when the first WGA was published for the 2009-10 financial statements published in November 2011. We too have been on a journey. But as Sage pointed out, it can change, and it changes every year. So let me share with you an example. There was a collapse of a large service provider to the public sector, a commercial company, Carillion, some of you may have heard of it, and where government had to step in to manage the fallout because there were schools being made that got left in the middle. There were hospitals, major road infrastructure, the actual maintenance and managing the prison estate all had required central government to step in. And you could question whether it was too big to fail, but it led to various questions within government to say, well, is government the insurer of last resort? And there is a report on this, well worth reading. And this was actually even before the impact of COVID-19 and the huge support that UK government, as well as many others around the world, have made. Another challenge that was mentioned earlier was talking about the legal framework. Now, I was fortunate enough last year to do some work with the Korean Institute of Public Finance. I understand one of my colleagues from there will be speaking to you tomorrow. And we were looking at the use of whole of government accounts. So just to say to Dag, okay, he didn't think we're using the whole of government accounts for the UK. We are using the information, not as much as we would like, but we are using the information. So it's it's a journey, and I would encourage you to note that it is a journey. So one of the things we were looking at in terms of central government, we also have to, when we're looking at the different legal frameworks, UK government, we provide information. The accountability framework is different because we have to provide information to Parliament that provides not information just on risk, contingent liabilities are risks, but we have to provide them not per the IPSAS 19 definition in terms of what is possible, probable is provision, we provide possible, we disclose it in the financial statements, but if it's remote, we don't need to disclose it at all, we note it. That's not the case for UK parliamentary accountability purposes. We have to disclose it. In fact, we disclose it and we disclose the non-quantifiable elements as well. So the disclosure is quite a lot more than it is for the financial statements. But that information was really important for using within, to use within a new central contingent liability central capability that was developed directly as a result of the government assessing the Treasury team, the balance sheet team, looking at what government's function is and government as an insurer of last resort. So any policy that's made at the moment, if there's a potential contingent liability and the value of that contingent liability is more than 3 million, it has to go through the Treasury spending teams. So there are no hidden liabilities bubbling under that we don't know. So that's just something to be aware of how the financial statements and the account and the ONS data is working together. One of the things that the Office of Budget Responsibility have identified in their fiscal sustainability report, fiscal risk and sustainability report, that UK government, in the support that it provided in terms of government loans, the value of those loans is approximately potential contingent liability is 16% of GDP. It's a huge sum. But anyway, just to be aware how it can be used. So we've got different boundaries, we've got different definitions. Which ones do you use? We've got different starting points, as John Buringer covered this morning as well, and he shared the challenges that they've got within EPSAS as well. So UK government, it was a sale of the state utilities, water, that I did in the early 1990s that identified the anomaly that local government has been on accrual accounting since the local government, and then public corporations, state-owned enterprises were following commercial-style financial reporting on an accrual basis, IFRS, and that was pre-IFRS. But then we identified that central government, arguably the ones that spend the most, they're not on accruals, they're just on cash. So therein started, and we had the lovely Professor Sir Andrew Lickerman, who was our change champion, pushing the agenda forward. So I would say my view is, when you're looking at your different starting points, remember, materiality is your friend. I think Sage said this too. Look at which entities are bigger, which you should include. And to Dag's question, can we get to a good answer than to the precise answer? So worth thinking about. So what I wanted to do was talk to you in detail, really, about the practical challenges. Let me share it with you with the UK case study. So why am I talking about this? Well, let's set the context. There were 483 local government bodies. Now slightly less now, probably about just under 400, about 440-ish, since some of them amalgamated. And then some of you might think, well, does that matter? Well, actually, when, it's only local government, central government spend the most. So why does that matter, Matt? And why should I be interested? Well, as some of you will know, and in some jurisdictions around the world, some of the municipalities have huge spending power and huge number of assets. In thinking about, even in Nigeria, you think about the states, you've got 36 or 37 states that are very autonomous and the power that they yield. Now, in the UK, you have just one example I'll share with you, Birmingham City Council. It was in the media recently, not for good reasons, but It's got an airport, an international convention centre, as well as being one of the biggest local authorities in Europe. It was said that it had a GDP of higher than Belgium. So including that is pretty impressive. I can't say if it's still the case today, because I worked in this team between 2007 and 2011. UK government is highly centralised in terms of determining what UK government tells us, central government, local government rather, what you have to deliver, how you can raise your funds, the reporting. It's highly centralised. So there are different reporting frameworks and requirements set out in legislation. There were different reporting periods to overcome, and no powers. Now, what I mean by that is, even though I worked in the Department for Local Government, making sure we collected the information, when I say we, for all of that, the consolidation, there was me and one trainee accountant. There wasn't a huge team. And we had no power. We couldn't make people do the work. And we couldn't offer them any clarity to say it will help you in this way. So how did I go about doing that? So, like I said, let's talk about the practical challenges and offer you some possible solutions. So looking at the practical challenges, group them together. Firstly, information requirements. So local government follow the local government code. That quite surprised me because Treasury, I thought, coming from central government, one assumes over central government, we know everything. No. Central government, Treasury set the code, the financial reporting manual, but local government set the code, which is that is set by SIPA, LASAC as an independent entity. So accounting standards are different, although they've been they align. I won't go into too much detail. I'm conscious time is not on my side. So we have there are different accountability requirements, statutory and funding. Let me give you an example. So there is a requirement within government that, local government rather, that there should be a balanced budget. That sounds eminently sensible. Each year we're saying how much money can be coming in. But if, as we know, demand on public services increases, and what they have to be is determined by central government under statute, and yet how much they can actually ask for money, that is also set by central government. It used to be the case that it was 2%, that the local taxes could only be increased by 2%. So it wouldn't surprise you to know, unless if you wanted more than that, you'd have to complete a referendum. You can imagine that most people wouldn't want to vote to pay extra taxes for increased local public services. So funnily enough, most local authorities would only raise their taxes by 1.99%. So there were different information requirements. Now that's accountability and statutory and funding. Secondly, different timetables. In central government, the aim is always for pre-recess. The accounts are prepared for the 31st of March to be delivered, to be audited, completed, submitted for review to Parliament before the time the ministers, etc., Parliament closes down for summer, round about the middle of July, so just over about 100 days. But just to say, local government, I'll just change the date slightly. The dates were brought forward to the 31st of May. Unfortunately, they've not been able to achieve that. And that was the aim, to try and bring forward the timeliness of the whole of government accounts. Unfortunately, with COVID, that timetable has now slipped. Only 1% of local authorities were able to meet the 31st of May deadline. And you could ask questions as what that means to local parliamentary accountability to the local electorate if we can't get the accounts out in time. But a discussion for another day. Eliminations. Now, I would say that was one of the most difficult things to do. Intra-local government, for 183 local government bodies, identifying what they were doing, what the eliminations were. Then the interest central government to local government, so working closely with Treasury to identify what could be central government funds that were going to local government to make sure they were identified and eliminated correctly. And also you'll know from IPSAS 23, soon to be IPSAS 47, the revenue fee versus capital, where central government may just give funding and it's at one. This actually is one of the, it seems like a tiny issue, but it was a huge practical issue to say, okay, if some funding had been given for 3 years previously, but it's spent in the current year, how do we then identify it if the central government gave it as a revenue, but local government reported as capital? Did it have stipulations? Does it have a conditions or restrictions? Does it need to be recorded as deferred income, or does it, and how can we effectively do the eliminations? Those caused huge issues. Okay, so I've given you all my tales of woe. So what are the possible solutions? You'll hear this again and again, buy-in, absolutely important. So engage with your data providers. I didn't go in saying I knew everything. I co-developed solutions with I asked for a group of local authority finance professionals to work with me and advise me to say, well, my view was, I need this from you. What do you need from me to make it happen? So we made the financial statements look like the financial statements for local authorities, and then the mapping was done behind the scenes. They could see it was all in an Excel document with macros built in. Lots and lots of investment in training and education. So I would work with them in terms of, I said to them, as long as you get me a venue, I will come along and provide the training to make sure, because that's all I could do. I didn't have any other levers to get their buy-in to that. Try to align the information requests. So understanding the local government and central government reporting requirements. I didn't win all of these battles. There are other reports that have to be delivered to central government by local government, and one of the challenges I didn't achieve was to actually try and get these aligned so that we only asked for the information once. But we did manage to align the data for the financial statements, not wider. And finally, I would say make it easy. The easier you make it for your data providers to provide you with data, the more likely that the data will come in, will be of good quality, and will meet their needs. So, for example, my data, like I said, the data collection pack replicated local government statement of accounts. I had loads of in-bit data controls and macros, so the depreciation charge in the PPE note would be the same as the depreciation charge in the income and expenditure. That just made sense. The balance sheet was auto-derived. And then also I made the toolkit, the data collection tool, as an educational tool. So I will put in the references to the different accounts, reference to say, it says this in the code, that's why it's been interpreted this way, just to make sure that they could provide the information. And also for the eliminations, we created I organized a website to be created where central government funding to local authority, the local authority could just look at a drop-down menu to say, how much money did central government record that they have given us? And then they could compare it to their notes to make sure that that elimination process could be made easier. You say, hopefully there's some tips in there for you. So what? I would just say, well, all local government data was submitted to the whole of government accounts. I would say mostly on time. Obviously, Birmingham City Council. For some of the local authorities, we made arrangements for, but in the main, they were delivered on time. There's an improvement in the quality of the data by putting in the macros, making sure that the balance sheet had to balance, trial balance, it will have to agree. Otherwise, the data collection toolkit could not be submitted to us for processing. Over 1,200 people every year came to the training events, and it ensured it broke down some barriers in terms of central government always dictate what needs to be done. There was a huge amount of more collaborative working. myself, I learned from them, and therefore using that learning to reflect back into a product that they could use for their benefit too. Like I said, I had no carrot and no stick. And one of the best compliments I was paid was by the National Audit Office when the auditor said, I never thought in a month of Sundays, Manj, could you ever get 100% return rate? And I did for the 3 years I managed that process. So thank you. Hopefully I've kept time. That's me. And I'll return back to them. I'm happy to answer any questions.
Thank you very much. Thank you very much, Manye. And now the last presentation of this session, Mr. Thomas.
Yeah, thank you very much. When I initially saw the agenda of this conference, I was very happy to see that I'm going to speak before lunch. Now it happens that I'm going to speak after lunch, and even worse, I'm the last speaker in the session after lunch. It couldn't be worse, actually. So I hope you're still with me, you're still awake, and I promise after my speech, there will be coffee. So we heard a lot about challenges, and we heard about the high level of costs connected with consolidation, which leads to compromises. We heard from Sache, consolidation being even a scary project. And we heard about compromises that entities will be consolidated at equity despite the entities being fully controlled as a result of the challenges in getting the information. So what I'm going to do today is not to speak about challenges, but to talk about lessons learned, and very recently lessons learned, because I'm going to talk about the use of AI, artificial intelligence, for consolidation. I could have, if I looked at the slide of DAC, I could have called my presentation as well, the new tools for new challenges. That was one title of his slide. But what I actually want to talk about is how technology can support in the task of consolidation. And as you see here, some quotes on the slide, and like the last one here on the slide is kind of like everybody's talking about artificial intelligence, and even those who are shaping technology think that AI will empower and improve every business, every government organization, every philanthropy. So it actually kind of will affect all of us. So nowadays, everybody talks about artificial intelligence, but I think it's important to realize this is not something new. And you see here on the slide that it has already been developed since more than 80 years, because artificial intelligence in general is nothing else like a field of computer sciences that focuses on creating intelligent machines capable of tasks requiring human intelligence. And as you see, the development of artificial intelligence kind of took place all over the last decades. And now we reached a point in time where we talk about generative AI. Everybody knows, at least from hearing, ChatGPT, which is like a technology that can create new content, such as images, text, audio, based on data. So that is kind of a technology which is translating data into, like, for example, visual presentation. And as all areas of life, artificial intelligence is also impacting accounting and auditing. And I just want to share with you some insights in what happens today and what is currently being developed. I will connect that with the marketing block, and you will realize later on what I mean with that, because I want you to become part of this journey. So when it comes to visualization of data, you may already know process mining as a tool. It is a tool to visualize data, especially visualizing transaction flows from a procedural perspective. What you see here, and I hope you can see it, is like the use of big data technology, which provides a fact-based and fully transparent analysis of transaction flows, of end-to-end processes as they are in reality. When it comes to, like, saying accounting oversight, or even auditing, because I'm an auditor by profession, very often we do process analysis in order to identify where may be risks, where may be risk for errors, maybe a risk for mistakes. What we look at normally is the process as it is described in accounting manuals. And this is what you see in the left white box here. This is the description of a process as it is described in the accounting manual. Is this how it works normally? Unfortunately not. But how does it work really, and where are the pitfalls, where are the risks? And process mining is one instrument which helps you to identify what are the flows in reality. And this is, as you see it in the right box. It is much more complicated, it is much more heterogeneous, and by that visualization, you can identify where may be gaps, where may be kind of errors, where may be risks, and where may be failures. And what can be done, what works with big data technology from a procedural perspective, also works from an accounting perspective. And this is what we call accounting network analysis. Accounting network analysis actually is an instrument that visualizes transactions from an account perspective. It visualizes transactions from a GL perspective. We already heard from Saché about the consolidation leading to better political decisions. That is true if consolidation is done correctly. But very often, a lack of traceability of transaction flows between entities is kind of leading to decisions that are based on assumed rather than on fact-based, non-existing transaction flows. It's again the same like process mining. You think that the booking behavior is in a way, but it is not reality. And how can we visualize reality? We can use big data. We can use big data technology. So very much this is the case for eliminations. The problem, as we discussed it before, we all know that we need to eliminate intra-group transactions, but we don't exactly know how they were booked. We assume how they were booked, because that is how they should be booked, but we don't know how they were booked in reality. And in this big data technology can help us visualizing that. So how does it work and how to read it? You see here on the right side, dots and arrows. And obviously, this is what the GL looks like if you look at it from a graphic perspective. So the the accounts are visualized by the dots, and the dots, the arrows between the dots visualize the value flows between the account classes. So the direction of the arrows follow the bookkeeping systematic, which is also the case here, debit to credit, and you see the size of the arrow, which represents the transaction volume behind. So a drill down to specific accounts is possible, even to the single account and the single posting. So what is the idea behind? And this is a single entity perspective. I will come to consolidation in a second, don't worry. This is a single entity perspective. The idea behind is that the accounting network transforms the general ledger into a graph, enabling finance professionals to obtain a complete overview of complex accounting practices as they were in reality, as they are in reality. And what can be used for one entity can also be used for consolidation, because it can be used for a large number of entities, and consolidation in general government or in government always involves a large number of entities. We heard even about Estonia being a small country, how many entities these are. So you kind of see that here transferred to the task of consolidation. This is the example of a debt elimination. So you see business unit 1, you see business unit 2. One unit delivers to another unit, which leads to kind of receivable versus revenue in BU1, business unit 1. In business unit 2, it booked inventory versus payable. And if you kind of bring those two together to an amalgamation, to a simple group accumulation, you see the slide, the box here. And now we come to the question, what do we have to eliminate? And you can exactly kind of put or drill down to the arrows in order to kind of derive what were the amounts delivered from one entity to the other entity in order to achieve and result the elimination booking, which you see here. This is the consolidation booking, which is then posted and leads to the consolidated financial statements visualized here in total. So in a single, in a table, which you probably know best, I think it's simply visualized. You see we have trade receivables of 250 in the BU1. We have trade receivables or trade payables in business unit 2. Obviously, this needs to be eliminated. We would have guessed that this is the case, but we would not have known it exactly, especially not what the postings in the P&L, in the profit and loss account was. And this needs to be the posting then in the visualization. This is how the tool looks from the desktop perspective. And the good thing is you can kind of group entities to whatever you needed. We talked about staged versus direct consolidation. We talked about consolidation following the path of the system of accountability. With this tool, it's possible to have subgroups like sub-national consolidation. It is possible to have line ministries plus their subordinate entities in order to follow the political dimension of restored responsibility. And it's possible to have kind of a whole consolidation shown in one table as well. And again, I told you, you can always drill down to the full detail of the arrows in order to come to the elimination bookings or postings as they are needed to come to a full consolidation. This is what is kind of just visualized here. I'm sure you can't read it, but that's not important. It's just showing that you can drill down even to the account level, to the single account. There's one bad news, of course, and the bad news is there is two preconditions. All entities need to be on a unified accounting system, and all entities need to use a harmonized chart of account. Otherwise, it's not working. I think that is obvious. That is one of the challenges which needs to be overcome. The tool is practice proven for a private sector entity or group, as you all probably know it. It's the Volkswagen Group. You might appreciate that Volkswagen is very big as well. It worked. The number of entities which can be kind of included here is nearly unlimited. That's the positive side of big data technology. So I'm very positive that it would work in the public sector as well. And this is where the marketing block comes. We would like to have a pilot using this technology in the public sector for government purposes. So whoever is brave enough to step up and wants to try this new technology is highly welcome. So with that, I think I'm concluding, and I'm happy to answer any questions as long as they are not too technical, because I'm the auditor. I'm not an IT guy, okay? So with that, thank you very much.
Thank you very much, Thomas. Very, very good presentations. We heard from cases from the UK, Estonia, and Switzerland and Spain. And then we had this wonderful presentation on how to exploit big data with AI and make our life easier, right? So we have now the Q&A session. So who's a brave one? Please.
Микрофон работает.
I'll speak Russian. Dear speakers, thank you very much for presentations. Although we had a great lunch, I'd like to thank organizers. Anyway, we were listening very attentively. And we'd like to thank you for this opportunity. You've shared with us your experience, you shared the methodology, you shared the analysis, you shared the experience of application of consolidation in different countries. You told us about problems that potentially may arise when we try to improve consolidation of financial reporting. Of course, in Ukraine, we do not apply artificial intelligence for consolidation, only software products, but hopefully we'll do it going forward. My question is very simple. Practically, if we have consolidation of financial reporting of two ministries, for example, we have two ministries. The forms of financial reporting are formalized in the form of the tables. The standards of accounting, national standards, they require disclosure on specific indicators. These are notes to financial reporting. It may be standardized. For example, in Ukraine, it is a separate table, and you can also add text format in order to disclose indicators of financial reporting, because not every accountant, with all due respect to your presentations, colleagues, but not every accountant can take the balance sheet, the financial reporting, and be able to interpret indicators. The accountants have to use some indicators which are disclosed in the notes. So my question is, if at the level of two ministries we can do some aggregations or consolidation in the notes to reporting to understand what happened with non-financial assets, what was the movement of non-financial assets, or what happened to financial instruments. In the countries which you discussed, which already have this level of consolidation, who is dealing with the issues of interpretation or explaining specific indicators of consolidated reporting to get the analytics which you mentioned, the deep analytics, because it is based on some elements of disclosure. So this is my simple question. Thank you.
You want to take?
I think this is a... Can you hear me? Yeah. I think this is a very relevant question, because obviously doing the balance sheet, the statement of financial performance, the changes in net asset equity, that's of course one piece of work, but then you also need to do the notes of the consolidated financial statements. In my experience, what governments really do is, well, they have to prioritize, because the number of entities consolidated is simply too large that you can go through all those notes in all details. But of course, you will have a look at the notes of the larger entities which are being consolidated. So, for instance, in Spain, I understand these are banks. In Switzerland, that's the railway company, for instance. And of course, then you have a very careful look at those financial statements and take the relevant information up to the level of government. Of course, you also look at the government itself, because that's also a large entity. So, of course, that will also influence. But you might actually neglect some of the notes of very small entities which are really not material at the level of the consolidated financial statements. And I think this is sometimes a bit stressful for accountants, because accountants want to have all information and not just a selection. but really that's where materiality comes in, and you have to focus on those, on the parts of information that are material.
Thank you very much, Andreas. Next question. Yes, please.
I have a question, which may be technical. I would like to understand when we determine the boundaries of consolidation. First of all, as I understand, we focus on sectorization, the way it was done. If sectorization was done according to GFS, then we determine the general government sector. All organizations which are part of general government sector should be consolidated. Second step, we apply the criterion of control according to IFMIS. IFMIS 35, if they include this into the general government sector, and so it is confirmed that there is control according to IFMIS, then these entities are included into consolidation, including SOEs. Next, extra budgetary organizations. Extra budgetary organizations, if also we confirm that there is control criteria according to IFMIS, we need to include them into consolidation. But if we have extra budgetary organizations which receive budget funds, but we cannot confirm the existence of criteria of control according to IFMIS, these entities, should they be included into consolidation? And if we include them into consolidation, then we have the same problems which we have with SOEs. They're doing accounting according to different standards, they use different forms and so on. What is your opinion about this? If these extra budgetary entities are not included into consolidation, what is the auditor's opinion about this consolidation? Is it in line with requirements of methodology of consolidated financial reporting, or it is not in line with requirements? If extra budgetary entities receiving the budget funds are not included, and if we cannot confirm the existence of control according to IFMIS and they are not included in the general government sector.
Will ask the first part of the question and then hand over perhaps to Thomas, who is an auditor, to respond on what he would say as an auditor. But the idea is really that you first draw up a map of all entities and say, well, this is part of the general government sector, this is part of the budget, this is part of the controlled entities. And then you have all those different scopes. And of course, if you end up having extra budgetary entities being controlled, then you need to consolidate them to comply with IFMIS. So in that case, they would be included in the example of Spain and Switzerland in the middle column, which is the consolidated financial statements, but they would not be included in the budgetary consolidation, which is the left-hand column. And then in the statistics, they would probably, again, still be included because they're part of the general government sector, so they would also be included. So they would be only included in the central column and in the right-hand column on my slide, and not in the left-hand column. Now, what would the auditor say if they are controlled but not consolidated? I pass this question to Thomas as an auditor.
Very, very elegantly he did that. Of course, what should the auditor say other than this would probably lead to an assessment of materiality. and the assessment of there is a material mistake in the consolidated financial statements if those entities which are controlled, but not controlled according to IFMIS 35 and therefore should be consolidated in the financial statements, but they are not. I can even add that there is a new standard on auditing, which is ISA 600. And ISA 600, which has to be applied from this year onward, even more focuses on the question of materiality, because the auditor of consolidated financial statements has to kind of look through the legal boundaries and has to identify risks and the question, what are material assets, what are material liabilities, and what are kind of the material aspects in the profit and loss account from a consolidated perspective. So it's completely regardless in which legal entity they are, extra budgetary, SOE, ministry, you have one kind of view on the consolidated financial statements, and that's the view of the balance sheet and the P&L of the consolidated reporting entity. And therefore the question would be, do the extra budgetary entities include any material assets, material liabilities, or material risks which should be kind of shown and reflected in the consolidated financial statements? And based on this answer, the auditor would either kind of include a qualification in his audit opinion or not.
Thank you very much. We have time for last question, so yes, please.
Thank you very much. My question is for Giuseppe concerning this shared service center in Estonia. Can you please specify in more detail what kind of services do they provide to single entities? Do they prepare only consolidated financial statements, or they are preparing also financial statements of single entities, or just they are receiving them and consolidating? And approximately how many employees do they have? Thank you.
So, as I know, they created this shared service center 10 years ago, 2013, and they are providing support to all national agencies, state-owned enterprises, and entity included in the WGA. So they are around 1,000. Is a huge number. In terms of legal personality, the center is an agency, is a national agency operating under the control of the Ministry of Finance. As I remember, a few years ago, there were around 25, 30 employees with financial management experience. Nowadays, I don't know the exact number, but there is a website, they have their own website, and they are working in close collaboration with the Ministry of Finance and the Estonian Standard Board. So in practice, as I know, they are supporting all the entities for the charter account according to IPSAS, and they are also supporting for consolidated purposes. So elimination of internal transactions, for example. Thank you.
Thank you very much, Giuseppe. Sorry, we are kind of out of time. We are almost having to return from the coffee break, but we didn't take any coffee. So I invite you to go to the coffee break. Please come back in no more than 15 minutes if possible, so we can proceed without further delay. Thank you very much.